Well, if you like triangles, you might really like rectangles. And rectangles, like triangles, are a trading range that are bounded by a support line on the bottom and a resistance line at the top. However, instead of like converging, it's more running parallel, forming the shape of a rectangle, as you'll see. And they'll continue along that kind of path, which gives us a lot of good trading opportunities inside the path until there's a breakout of the rectangle. Now you might say to yourself, well, which way does it break? Does it have a tendency to go a certain way, whether it's going to break through a support line or resistance line? The answer to that, because it's a continuation pattern, is it's going to follow the direction of that previous trend. See how continuation patterns will follow the original trend compared to, let's say, reversal patterns. But rectangles are by nature a continuation pattern. So we'll be watching those trends and that overall direction of prices, either up or down, and then we'll see how the rectangle forms, and then we'll see how we can maybe trade around that. So if you look towards the middle of the chart and think about those support line at the bottom and a resistance line at the top, if you were to draw those two lines, and form a rectangle, just visually look at this for a moment. What might it look like on your chart? Where you'd be drawing it on there? Think connecting the highs and the highs together, maybe at the top, and lows to lows with horizontal lines. So if you saw something looked like something like this, well, terrific, you were right. If not, that's okay too. We're learning here. That's the whole idea. I just want to give you a little kind of mini idea as we're going here. And you can see in this particular rectangle pattern that there's an uptrend that we're entering into the rectangle into. So in this case, there's a continuation pattern, so it'd be a definite direction, which was this uptrend. But then it gets kind of in this narrow trading range of resistance and support lines. It goes up and bounces at a resistance line, which can't push the prices higher. The buyers or the bulls can't push the prices higher, so prices come back down. But a new trend doesn't form. It doesn't turn into a downtrend. It basically stops at that support line and then turns around and starts going back up towards the resistance line, and so on, trading in this range. And how wide the distance between the resistance line and the support line will vary by the security and at that moment of time. Sometimes they can be very, very narrow. Sometimes they can be much wider, of course. So it's not so much the idea of how wide or narrow it is, it's more of that it's actually formed this rectangular pattern. And if we look at that, you can say, oh, well, there's opportunities where I might want to buy, or there's opportunities where I might want to sell within a rectangle pattern. And that's true. We want to make sure that the pattern has fully formed. So again, we're looking to buy in at the number 2 or 3 touch of it. You could buy in, let's say, you can see the first touch there. I don't have an arrow there. The second touch, I don't have an arrow there too, though a lot of people will buy in the second touch at that support line. A real good confirming way is to buy in at that third line. You can put in a buy number 1. And then you can wait for it to come back down. It's either going to break through that resistance line at the top and keep going, but if it turns around, there's a really good chance it's going to bounce again off that support line. So once it comes back down, if you're a little bit later or seeing this later or want to be more sure, you could buy at the number 2 position here. So you can buy in the second, third, or fourth touch. If you're looking to sell the security, one thing you can do is do a lot of trading instead of waiting for the trend to go back in a certain direction. You could just trade frequently within the rectangle. So every time it comes up to a resistance line, that's where I'm selling. So I would be buying, let's say, at the support lines, let it have its run up, sell it to take my profits, let it come back down. Right now I'm out of the security. Once it gets down back to that support line and rectangle holds, I'll buy it again, and then kind of repeat that until it breaks through as far as breaking the pattern. But until then, what a nice trading opportunity to trade frequently as far as buying and selling inside the rectangular pattern. All right, so let's say in our rectangle here, where do you think the price will go next, right? I mean, we're now at the top, we're at a resistance line. It could either break through the resistance line and go, basically go upwards, to where I've labeled letter A, or it could turn back around and go to letter B. Now, we don't really know, but if you were to guess, maybe you'd have an idea of a guess around that. Guessing is not something we want to do in technical analysis, by the way. But when we're looking at a chart pattern for fun, you can kind of think about which way it might go. And how you can really help confirm that when you reach, let's say, the top or either resistance line or support line is look at your other indicators to help confirm things around volume, moving average, relative strength index, things that you're learning in the course, where it'll also give an indication of like, oh, this is a buy opportunity or a sell opportunity. So use those other indicators to help confirm that you'll learn in the course what might happen here. But let's say I told you it was either going to break either through resistance line A, or it was going to turn around and go all the way down and break through the support line B. Just based on what you see here, which one do you think it is? I'm not giving you any other indicators. You just got to go with the pattern here. I'm just telling you it's going to do one or the other because I'm the instructor and I'm having fun, and hopefully you are too, right? Which one do you think it is? Now, a little hint here, rectangles are trend continuation patterns. What was the trend coming into the rectangle? So if you thought, okay, I'm in an upward trend, so I'm going to say A, well, you would be correct, because that is, the uptrend was already established before. The uptrend then went into this rectangular up and down pattern, and if it was going to break through, we'll be watching for it to more likely break through on the letter A there, break through that resistance line and continue our uptrend. So that you can see that if we're, say buying at the support lines, and even if we're doing frequent trading within the rectangle, because I bought at that support line, once it approaches that resistance line, if it turns back away from the resistance line, I could sell, get out, and then do it all over again at the support line. Or since I've already bought at a support line, I could buy again, or if I've held it through this whole period, by the way, too, and I bought it way back when, on that uptrend, I could then hold on to it and wait for it to break through that resistance line and continue the uptrend going upwards is the idea. Now, if it was a downtrend, it'd be the exact opposite, right? So, just think of this rectangle in just the line on the left there flipped, where it would be a downtrend, and it would break through B, break through the support level, and continue the downtrend. And you adjust your trading accordingly. Now, sometimes rectangles will have that same, parallel move between the upper and the lower, the support or the resistance line and the support line. And the key is they're not converging. They're moving parallel together, but they don't necessarily always look on their side like in a sideways market. Sometimes they can trade on an angle or on a slope, either kind of continuing that uptrend or continuing that downtrend. Even with inside that, it's got some movement inside there, and that would be what we call a channel. It's really a rectangle, and there's a channel of prices that are happening. But the idea is it's not converging like a triangle. It's still this narrower trading range, and then to treat it appropriately as a rectangle. Again, triangles and rectangles, continuation patterns, trend is your friend. The idea is you're going to watch for them to go through. If they do break through, they're going to go in that same direction of the original trend. Nothing's perfect, of course, that's very important, but that's the idea of these chart patterns that have been proven over time. More likely than not, hopefully is the ideal continue that pattern. Arguably, one of the funnest names in patterns is the dead cat bounce. And traders love dead cat bounces. It's a continuation pattern, so it's going to continue whichever way that trend has been headed before. And they love it, not just because the name's kind of funny, but it's actually a very good trading indicator, as we'll see here coming up. And they're very rare, actually. When you see a dead cat bounce, sometimes you'll see forums or people who are talking about trading say, oh my gosh, it's a dead cat bounce. And or it seems like it's forming. Watch out, it looks like a dead cat bounce. So you'll see some of that out there. But because it's rare, but the reason that traders love it or like it is it's very consistent. It's one of the more proven patterns out there. It's a very consistent pattern. And it includes a gap as part of the overall pattern. There's a gap in prices, as you'll see when we walk through how this works. And a gap by its nature is a very strong indicator as well. So you have an indicator that as part of the indicator has a strong indicator built kind of right into it. So that helps to make it very, very consistent is the idea of a dead cat bounce. So let's look at a dead cat bounce and how that kind of works, because it's a chart pattern that'll take a little bit of time to form because certain conditions have to be met along the way. So what happens is you see this, we're going from left to right, of course, with our time farther back in time to the right, more recent times, and prices, high at the top, low to the bottom. So what we're seeing here, you can obviously see that there's a downtrend, right? Remember, whenever we're trading chart patterns, there has to be an established trend. So what we're seeing here, and this is a dead cat bounce, there's a downside breakaway gap. So you can see the three bars to the left, the three price ranges, and imagine before that there was an established trend too. And then all of a sudden there's a downside gap, right? There's a big gap in prices. The lows of the previous day were well broken and went to even lower lows, and we have a gap in prices there. Review or take a look at the lessons around gaps and trading gaps. We'll learn more about gaps. But the whole idea is there's something's happened. There's some type of big bad news or something happened to cause a big drop in prices. And then typically for a dead cat bounce, you want to see a dramatic drop. It's not a small 2, 3, 4% breakaway gap or big drop, or drop, you were looking for something like 25% or even up to 70% drop. You're looking for some really bad things to happen. Your cat is dead, unfortunately. And so you have this big gap. So look for a big gap of like a 25 to 70% price drop. And then it basically, forms this, it goes in this now new, even steeper downtrend. And then it reaches a bottom of the downtrend and it hits the floor. Your dead cat hits the floor and it bounces. So you see there's another breakaway cap off the bottom where it bounces up, right? The prices have now made a leap up. And it doesn't have to be a dramatic leap up, just that there's a gap that's formed. The idea is that it's gone. You've had a downside gap. Things have gotten even worse. It keeps going down, down, down. It looks terrible. And then it bounces off the bottom. And then it starts going up. And so it's a short, the idea of the formation of the dead cat is it's a short-term thing. It doesn't reach the original price gap prices. It doesn't, see how it does, when it reaches its peak, it doesn't go above the prices or above where that original gap was back to the original, let's say 3 downward lines there on the far left. It's going to kind of start to approach that, but then it's going to turn around again. Again, a dead cat bounce is a continuation pattern. So it's going to resume that strong downtrend. But the idea is something's bad happened, drive it down, and people are looking at it as it hits the rock bottom and bounces. They're saying, this is way too low. Maybe this has been oversold. Let me buy in, and then that you get more buyers, and that has the bounce. That's your breakaway gap. That's the bounce. So the idea is you want to trade on the bounce, but be ready to get out, right? So you're seeing this happen. It bounces up. You see a breakaway gap. You need a breakaway gap going upwards, not just a trend going upwards. You need a breakaway gap going up to be a dead cat bounce. You trade on that, short-term trade, but you're ready to get out, especially as it starts approaching that first breakaway gap to the downside or approaches the last kind of low in the previous downtrend low. You want to get out and take your profits, because what's going to happen with a dead cat bounce is it's going to reverse, or basically this temporary bounce, this temporary reversal is going to go back to the original downtrend. So be ready to get back out. You can have the exact opposite of that, and that's even rarer than a dead cat bounce, which is an inverted dead cat bounce. Just imagine this, but you're in an uptrend, and all the same concepts apply. It's just in an uptrend is what would be happening. Again, very, very rare, but if you see that, you can kind of trade appropriately around that. So the idea of the dead cat bounce is it's a short-term kind of profit opportunity, and that's why a lot of traders like it, besides the funny name, is they can get in and get some profits, but they're really watching it closely for any sign of a turn that might be turning back down to that downtrend, and then they get out right away. With a dead cat bounce, you want to trade on the bounce as it bounces off the floor. You don't want to go back into that downtrend, because the downtrend is going to keep getting worse. It's going to go past that floor and start creating new floors on this bad downtrend. So dead cat bounces are good trading opportunities, but just be aware of how to trade them. That's the real key part, is that you're trading the dead cat bounce. It's not something you would hold for long periods of time. You're just trying to trade on that bounce, get in, get out, make some profit. A very interesting chart pattern is what's called a cup with a handle. It actually looks like a cup with a handle on its side is the idea. And what makes it interesting is it's not only a chart pattern by nature, but it's combining these price patterns like you'd have in a chart pattern and trends and all that with things. Really, you have to have certain other factors or indicators that are part of that. Volume levels, how much trading and buying and selling is going on, as that cup forms, as we'll see here in a moment. And you're going to use an indicator, the moving average indicators as well too, to help kind of confirm all this as well. So they all kind of work together, and we'll walk through how all this works, including the moving average a little bit, so you can see how this all pulls together. And it is a continuation pattern. So the idea, if the trend, and the idea of a cup and handle is the trend, let's say it's going upward, cup and handle will form, and then the trend will continue is the idea. So it's a continuation pattern and takes time to develop. So this is one that does take time to develop, but when it does, and if it does, it's a very, very strong indicator when it does. We'll walk through why that is from kind of the psychology of what's going on with investors and traders that's forming this pattern. And as I mentioned before, it's fun because it looks like a cup. So if you can start visualizing a cup on its side, not the downward one, but on its side with your cup and your handle, then that's kind of cool, right? It kind of is an interesting thing. So let's take a look at a strong indicator, cup with handle. So if you look at this here, this chart pattern, let's start off, let's see if we can guess. Let's do a little more guessing game. So look at it and just start looking at it. You're looking for a cup. So in a cup, let's say you're looking at its side, you'd have a cup that would hold a liquid, right? So you're looking for an indentation in this chart pattern, these price lines that are going on this upward trend. Can you see the part where there's a depression where you could maybe put some water or some, adult beverage if you like? And is there a handle that might be on the, looking at our screen, the right-hand side of that cup, because they're going from left to right as far as time? So that's what kind of the pattern looks like. If I put a little bit of a highlight on there, you kind of see how it's starting to form like a teacup, right? Like it's starting to form a cup around there is the idea. So that's what you're looking for, is that cup with the handle. But to get there, well, there's a lot of things that got to happen. So let's put a whole bunch of stuff on the chart and let's walk through it. So first off, let's start at the very far left. We've got to have an upward trend, right? And as you can see here, the general direction, if we were to draw more specific trend lines, but you can see that the slope is upward, the prices are getting higher. There's an upward trend. And then you can see that the bottom of the trading volume is kind of like this medium trading volume that you'd see looking over the history of the prices for your security, whatever trading volume it is. Some securities trade a lot all the time compared to others, but you're looking at this particular securities, horizontal or vertical bars at the bottom. And let's say this, blue part represents that range of volume, and it's kind of a medium volume, right? So it's on a nice upward trend, nothing exciting happening, but it's a nice, good upward trend. Maybe we bought in earlier and we're hanging in there. That would be terrific, right? That's maybe the idea. So we're seeing this happen. We're seeing this trend. And then it starts to reach a peak and starts to go downwards, and then it goes down in the cup part, and it starts to go sideways, right? So it doesn't go into full downtrend mode. It just starts to go sideways. The prices kind of bounce up and down a little bit in more of a flat part, forming in fact the bottom of the cup. And you'll see the trading volume is low on this. So you can see how they're all working together here, that the trading volume is low. And then as we go back up, you'll start to go back up, and then a handle forms. And that's when the handle forms, and certainly when there's the continuation pattern of the upward trend, we're back to this rising pattern, back to this upward trend. But one key part of that is that the trading volume is higher, right? So all of a sudden, a lot of people are trading it and they're driving the prices higher. And then all along this, you're looking at this, you want to overlay on this is the simple moving average, or you can use a different type of moving average, like a weighted moving average. Look at the section around moving averages and learn more about moving averages. But basically, like let's say a simple moving average is looking over, let's say, the last 10 days or 10 periods, typically days, and saying what's the average prices. And really where that line comes in there is to form the bottom of the cup. We don't want those to go either too far, but we would rather they didn't break the simple moving average at all. But if they, or only just go a little bit below, just a little titch. We don't want it to go way below the simple moving average, because then we don't have a cup. We have more of a downtrend, or we have more of a V-shaped cup, which is what we don't want. We want more of a U-shaped type cup like we see here. So you're using that simple moving average to kind of help confirm and be a basis on that. And you can see how it follows along with the trend lines above it as far as that simple moving average. So what's happening here? So this is what it is, and you can trade off that, right? You could have either invested in the upward trend and then see the cup form, and you're hoping the cup forms, you hang in there, and then once you see the handle, you really hang in there because now you're going to be in an upward trend. Or maybe you're not in this security at all, and you see this cup forming, and then you see the handle, and you start seeing that sideways move in the handle, then you're starting to trade in there because you know an uptrend is coming, or you're hoping an uptrend is coming, and because it's a continuation pattern. And so you're buying in at that point as well. So you either had bought in earlier and you're holding through the cup and handle phase, or you see the cup and handle forming, and now you're buying somewhere in that handle, or most likely you're buying, actually probably a better thing is you're buying a little bit slightly up in the cup, or excuse me, a little bit slightly after the handle, because you want to have that uptrend definitely form. But if you think about the psychology of what's happening here, is that we've had this nice uptrend and it's been going up. Well, we're going to start back on the left here looking at the volume and stuff. A nice uptrend, steady uptrend, buyers are buying, and it's just kind of a steady uptrend. And then it loses steam, right? That's what happens to chart patterns. They lose steam, and it's either it's going to continue later, but it starts to go reverse the other way. And then so the prices go down when people are taking profits, and maybe that's what's happening. Prices are going down, but there's low trading volume. It's not like there's a lot of excitement. It's not like there's something bad that's happened and the trading volume's high, driving the prices way down. It's just kind of like, it's just kind of really getting low volume, kind of boring, just kind of moving along. moves along the bottom of that simple moving average. The cup is in fact above the simple moving average line, but this cup is forming. But again, it's nothing like sighting going on from volume. Then the volume starts to pick up, and people are like, oh, okay, well, maybe it's picking up again. And then what happens is those who didn't sell, towards the bottom of the cup might be selling now at the top of the cup or along the handle, right? They can't decide which way to go, the buy, sell. There's a little bit of movement, but now there's more trading volume coming in. And so that's starting to move that handle a little bit. It might actually, start ticking up a little bit just itself. It doesn't have to be a fully horizontal handle, but it's going to be, and it usually isn't, in real world. But it's what's going to happen is you're going to start to have this high volume and you're going to have this upward trend. So that's kind of, and then people are like, oh, this was just a temporary setback, that cup part, maybe a pullback. If I held on, I'm just going to hold on and really now ride this upward trend. And other people are like, all right, they had this temporary pullback, handle formed, indecisiveness at the handle, definitely went into uptrend, and now I'm back in buying because I know that uptrend is going to keep rising above there. So that's kind of the psychology behind a cup and a handle. Also, one thing to consider too is the longer the U shape of the cup, the more it's more predictable than a V-shaped cup. So if you see that that we have this long U there in the example that we're showing here with this cup, it looks like a U, but it's really kind of flatter and longer than if it was a real sharp V type of a cup. Also, the cup shouldn't be overly deep. The idea is you've had some indecision, you have some profit taking, but it shouldn't be driven way down low. It shouldn't certainly not be driven below the simple moving average line. That's what helps us with our cup. So it should not be overly deep. If it was really a deep cup, then it might be people are not as indecisive or taking profits. They might be an actual real trend reversal, and it's not really a cup and handle. It's actually something different going on. So look for U-shapes, longer U-shapes in the cup to be more confirming. And then also look that the cup is not overly deep on it, and that'll really help you well. So as you probably saw there, you're saying, well, that's a lot going on with a cup and handle. It looks nice, but I got to really wait for that pattern to develop. And that's true, and you have to let it develop. But as you can see, there's strong indicators and multiple indicators on top of indicators, so that builds a great trading opportunity. So it might not be something you're trading every day, but if it kind of jumps out at you and slaps you in the face, like you might want to take notice of it because could be a great trading opportunity and to ride a long-term upward trend after a pause there in the cup. So chart patterns, as we know, are designed to tell you if either an established trend, that's key that there's an established trend either up or down, and will that trend either continue, a continuation pattern, keep going the same direction of the trend. Let's say it's an upward trend, it would keep going upward. Things like triangles, rectangles, dead cat bounces are continuation patterns. And in this upcoming lessons, we're going to talk about reversal patterns, where you're not going to continue that trend. In fact, the trend is now going to reverse. It's either going to go sideways or it might completely reverse and go, let's say if it was an uptrend, it would go downward. And if it was a downtrend, it would reverse and go upward. Obviously, we can see that if there's a reversal pattern happening, we might be waiting for that trend to happen and for that reversal to happen. And then that might be a good opportunity to either buy in for a reversal that's going to lead to an upward trend, or maybe we're selling at more of a peak, let's say to when a downtrend or an uptrend is going to reverse to a downtrend. So either way, the idea of a predicting nature of an indicator is very, very powerful. So we're going to talk about in this section, reversal patterns. The trend is going to reverse. So as we know, in an established trend, there may be a pause in buying and selling. That's the same with a continuation pattern or a reversal pattern. The trend is starting to lose steam. And when you see that reversal pattern, that is indicating the current trend will end and a new one is beginning. And so we take appropriate action based on that, depending on which way the trend was headed in the original direction of the trend, and then it's now going to reverse. So let's take a look at some of these different types of reversal patterns that we can be watching for. All right, let's get a little alphabetical, right? So one of the more popular, or common, I should say, and popular to trade on patterns is a double bottom chart pattern. And they're more common than a lot of other types of chart patterns, and double bottoms and double tops. But let's talk about double bottom chart pattern. Basically, it's going to look like the letter W, right? And what's happening is you have a downward trend and it's retesting of these lows at the bottom of the W. And the idea is it's going to predict a price breakout. It's going to break out of that trend or reverse out of the downward trend and going to break out to the upside. That's the idea. Is under certain conditions, we're now going to break out to the upside. So let's look at that and how those form and how we can trade off of those. So if we look at this example, this is, all the prices, high to low, made into a line chart here. And it looks like a W. Do you see the W there over on the left there? And the idea is that it's retesting of the lows is the idea. So, and then they will predict the price breakout to the upside under certain conditions, as we mentioned. So look, if you see the double on the left, if not, here you go. You can kind of see how the W is forming. So you can see the prices were higher, they go down, then they bounce up, and they go down and they bounce up again. So that's the idea of the W part of it. Now let's talk about how do we trade this? I mean, so we see a W, that's nice. But how does this really work, right? So if you see, we're starting with a downward trend. So over a double bottom, it's a downward trend and it's going to reverse is the idea. So you're going to hit bottom basically twice. Think of like those would be, we could have drawn a support line along the bottom, but you can see where the prices hit the first bottom, and then they back up into the middle of the W, and they reach a peak, and then they go back down to the bottom, forming the next side of the W, and then after that they go back up. So that's our double bottom, right? Once we've hit the bottom twice, we've now formed our double bottom. And what we're looking for is now it's going to hit that confirmation point. You could also call it a resistance line. If this was a rectangle, it would bounce off that resistance point and keep going back down and kind of trade with a narrow channel. But when we have a double bottom, it's actually going to break through that point right there after the second bottom. And that's your confirmation point. Once it's broken through there, a new trend is forming, and you use your upward trend type analysis, in a second touch, or that you now have when we look at drawing trend lines. But the idea is that's your confirmation point that is broken through that top of the middle part of the W. You can see where I drew this line straight across. And then you're buying there after it's gone up above it a little bit, maybe over a period or 2 or 3, and you're now going to ride this uptrend. And it's very common for a pullback to happen then. So we've been on this long downtrend, hit bottom twice, broke through at the top, and now it's reversed from a downtrend to an uptrend. But there's a little bit of pullback, a little bit of profit taking, not unusual, actually very common, and it'll actually maybe dip below that confirmation point. But the idea is hang in there, because the idea is it's going to then continue with a double bottom. It's going to continue on that uptrend. It may just keep going on that uptrend, but having a pullback with profit taking is not unusual, and that's okay. Just be aware. So when we buy in there, we can then ride that uptrend up, and we could sell at the top there if we want to take a short-term profit. But the idea of a double bottom is we're maybe looking for that upward trend. So for a double bottom, there are some conditions to be met, some generally accepted conditions. And typically you're looking for a minimum of 10 days between the lows. Now it could be months, so this is a longer type of chart pattern. I suppose you could trade it over, shorter periods, but traditionally you're looking at days, so it's a day type trading over days. A minimum 10 days between the lows, so between those two bottoms. And it could be months if you're looking at longer patterns. And the variation between the lows is no more than 4%. They truly are within each other, very narrow, or very, like if you draw a line along the bottom there, they're very close to that support, it would be support line. So there isn't it actually looks like a W. It doesn't look like something, like a lightning bolt that keeps going downward. It looks like a W that's formed there. And then that center up move, is a minimum of 10% from the lower of the two bottoms, right? If it just goes up a couple of percent, you got this really funky looking W. That's not it, right? So it needs to move up 10% from the bottom and really form. It may not be a perfect W. Nothing's, it's not going to look visually perfect, but it's going to look very clearly like a W is the idea. And then the price must move above the confirmation line. That's the important part of a double bottom chart pattern. It's got to break through that confirmation point to show a true reversal. Even though there might be a pullback later, it's got to break through significantly through that confirmation line. So, you're looking for that as well. So when you're looking to trade on a double bottom, you need to make sure that these conditions are met along the way. But it can be a very powerful pattern to trade on. All right, let's talk about moving averages now. And I love moving averages. I think they're a real powerful and yet pretty simple way to apply some technical analysis easily and quickly and really get a good visual on that. And one thing we know is that, prices, you can probably see from all these price charts, they don't move in a nice straight line, right? And they don't move, real nicely. They are all these ups and downs and all that, and kind of, doing that. And a moving average helps to kind of smooth that out so we can kind of, a picture of what might be happening with the prices in an easier to identify manner. So in this section, we're all going to talk about moving averages and how we can apply them to our trading. So moving averages are also known as dynamic analysis. So if we think of what a moving average is, as far as just what is it, it's it's a key component of technical analysis for sure. I mean, it's one of the things that you see often used, often as a default on charts, where you see these lines going across the chart. A lot of times those are a moving average line. Again, it's going to smooth out the pricing, so you're not going to have that choppy up and down. It's going to have a smooth kind of line. It's going to kind of smooth out those pricing depending on what moving average you use. And it can adjust for pricing outliers, right? Where you might see prices going up and down, so there's a big high and it comes down, and then there's a big low and it comes down. A moving average will smooth that out and basically account for those price outliers, either high or low. And they also work well with using them with other indicators, whether it's candlesticks or sentiment or volatility or momentum, whatever it might be. There's different types of indicators out there that we're learning about, and they pair well with moving averages, so they can be used for these other indicators. And they're very good at helping to identify trends and helping you to take certain actions around when you see something happens with a moving average indicator. What do you do next? Do you buy? Do you sell? It actually can be very, very apparent looking at these different trends and the ways that you can apply moving averages, which is what this section is all about. How can we apply that, and how can we be better traders around that? Now, a couple of things to understand about moving averages is, one is they are a lagging indicator, right? They're looking at averages going back over a certain period of time that you decide how long you want to look back as far as that period of time. But it is, because it's looking backwards, it's a lagging indicator, so it's not a forecasting type tool, or a trend following tool. It's more like looking, a little bit backwards. So it's a lagging indicator that is still very helpful as far as what you might decide to do going forward, but it's not designed to look forward. So, and also you don't have to try to figure out, the start and end points of it, which is nice. When we were looking at like trend lines on, we had to figure out, well, where's the start? Where's the end? Then I got to draw my trend line. You don't have to do any of that. You don't have to do any hand-drawn trend line drawing or anything like that. It's all basically mathematical, and the trading platforms do this all automatically for you. You just set the parameters, how many days basically you want your moving average to look at, and the type of moving average you want to use, which we're going to learn about. And then it's all shown right on the chart, and then you can make decisions based on that. And so the subjective part is really just choosing that moving average you want to use and how many periods. The rest of it's mathematical and automatically done for you. So let's get into that a little bit and how that would really work. And some of the different types of moving averages that are out there. We're going to start with the simple moving average, really the most common one. Another powerful tool that you can use in this whole moving average kind of section here is called the moving average convergence divergence, or MACD. Moving average convergence divergence, and it's really widely used. A lot of people use this. In fact, a lot of times it's a default setting on a trading platform, which will automatically just kind of show you that, and we'll have a graphic here in a second so you can kind of see what it looks like too. But that's how popular it is. And the reason it's popular is it's trying to overcome that challenge that a good disciplined investor, we want to be good disciplined investors, and we have that challenge where we're waiting for the price to cross over a moving average, for example, or another moving average to cross over another. We're waiting for this crossover rule to happen, and we can see it forming. We can see it's coming. We're hoping it's going to come, but you wish you could take action now, right? You wish, like, could I just get in a little bit earlier? Do I have to wait for the crossing? Well, yeah, you're a disciplined investor. You got to wait. But with the moving average convergence divergence measure, this gives you an opportunity. Maybe you could, get in there a little bit early or out a little bit early, depending on whether it's converging or diverging. So let's take a look at that. But that's the whole idea, is it's overcoming that challenge of waiting for the crossover to happen. So if we look at it, with crossovers, you see a merge, right? You see them coming, and you see a turning point, and they're approaching, and then when that happens, then you're looking for a new direction to occur, is the idea. And by that time that crossover occurs, it's lagging indicator, right? So the absolute peak of whether it's a peak or the absolute trough or bottom has already passed. So you can't buy at the absolute low, or you can't sell at the absolute high. You're waiting for that lagging indicator to catch up and really give you a good solid answer on it. And that's a good thing about moving averages, by the way, because it gives you some good solid indication, basically. But this is where the MACD comes in again, where you're going to visually see or quantify that there's an opportunity here, and you're going to try to get in at that, either in at that trough or out at that peak a little bit more. So when we think about convergence and divergence, convergence would be coming together, right? And then when you have convergence, it indicates a trend. We're looking for trends, that a trend may be coming to an end. It's kind of an early warning signal. So we've got a trend, it could be up, it could be down, but something's happening where there's a convergence, and that's a signal that the trend is going to, come to an end here. And we'll see that graphically in a moment. A divergence, think of that as going apart, or, more daylight, it might be a way to think of it. And so the current trend is safe from a crossover or a reversal. Remember, we were looking at those ones with that more daylight. We knew, that the far left of the graph, we had a lot of daylight, so it'd have to come really far to get to that moving average. We had a little bit of safety there. So divergence of more daylight or going apart, it really is an indicator that the trend is not going to reverse. If anything, it looks like the trend might be safer for a longer period of time. We will continue to ride that trend, at least for a few more periods maybe. However, abnormally wide divergences are not sustainable and can be a warning that prices may have started to reach an extreme. I mean, you think about it, if there's these wide price ranges, we might be really kind of approaching that peak. Or maybe we're going the opposite way, we're approaching that bottom. So it's another way that you can, where a convergence is really indicating a trend might be coming to an end. A divergence might be also a warning signal that, things could be good, but it could be a warning signal also that we might be hitting either that trough or that peak too. So we can use this MACD to kind of help us with that. So if we think about it, how it kind of is calculated is you take a long-term or a longer-term moving average prices, and they're subtracted from the short-term moving average prices, right? So it's kind of mathematical. The trading platform will do this automatically. You just choose that you want it, to indicate the MACD, and then it'll create a nice line on your chart, or it'll create some information there for you. It's created by George Appel, and he used exponential moving averages of 26 and 12 days. Although you can change the parameters if you want, but really what I see in the literature and everything, everybody's pretty solid on this 26 and 12 days, but you can adjust it. Though most people would recommend that you stick with it and just use what's been kind of tested and proven. So that's what we'll use here too. So if we look at our chart, here's our familiar chart again. We've got we put in a 12-day and a 26-day, simple moving averages, the blue line and the pink line, as you can see, and it moves across our prices there. But at the top, because we automatically defaulted, we selected these 12 and 26 periods for an MACD. You can see that you see some lines kind of going together, a 12 and 26 line, looking at these convergences and divergences. So let's look at what this is telling us. So if you look at the far left, when you see the lines rising, or the two averages are basically what's happening there is the two lines are diverging. And so that means the trend is going to continue. So, diverging means trend continues, right? Though we might be peaking or troughing, a trend is going to continue. So if we look at the top of our chart here, and we see these black and red lines kind of going up there, that's the lines are rising, and that's indicating that the trend's going to continue. And if we look down, if let's say we're way back in time on this, you can see how, yes, obviously that trend was continuing in this case. Once they start to flatten out at the top, and they start flattening out, and they start coming down, then when the MACD line falls, that means the trend is ending, right? So the two averages are starting to come closer together, and they're converging, and the MACD is going to represent that to us as far as that happening. And we can see it on the main chart too. You can just start seeing those moving average lines starting to come closer together, less daylight, and they're coming closer together. It's just that the MACD is going to give you a little bit of indication of that coming, maybe ahead of time. And then we go so on and so on throughout that. One thing too is on the far right there, I said where I have a note where histogram may be easier way to visualize. If you look at that those blue bars there, the histogram sometimes can be an easy way to visualize that. You can see where you might have peaks and valleys in the blue line, and where it gets really narrow to the main line, which is 0, how MACD would be +1, -1, and up and down from there. As it approaches that's when they're kind of converging together. You can see how close they are together, maybe easier with the blue part than you can with like the red and the blue crossing each other. But when they cross, that histogram should be basically almost 0, basically is what it would be. So this is interesting. This is great. You're saying like, okay, but I can kind of see it on the other chart too. Where is this helping me? Well, if you look closer at it, I'm going to put on some highlights here. The real advantage of this MACD is going to tell you earlier what is happening with the trend. That was our whole idea, right? and we want to see things happening a little bit sooner than waiting for the price line to cover. And so the gold circles, show the ending in this example of an upward trend, right? There's a sell signal going on, and you can see where, where there's these, let's say the lines are crossing, and when it was first going down, as the blue line starts heading down and starts to cross for a little bit and then goes back up, or it's crossing over prices, crossing below, prices are crossing below, let's say the blue line, or crossing below, the longer line. If you look at vertically straight up between these two circles, you can see that the MACD is giving you an earlier sign, a few periods ahead of that something might be up and to be aware of. So that's where people use it, as far as I'm using my pricing, my moving averages to make buy and sell decisions, but I might be using that MACD to give me an earlier warning that something's happening, and I might be able to actually act before they actually do have a crossover period. So that's the whole idea behind MACDs. Again, nothing's perfect, but that's the idea behind them, is you're trying to get an indicator ahead of time than waiting for the prices to happen as far as crossing over. In addition, you can use other indicators in combination with these to try to get confirmation that that's truly what's happening as well too. So if you see lots of blue lines, or excuse me, at the top of that MACD, you can kind of get a feel for what's happening, and then it's going to indicate what's happening below in your chart too, as another way of trying to maybe get ahead of a little bit. Or another thing that might indicate to you where you're looking at and say, oh, I think a selling time is coming. Oh, my MACD is kind of confirming this a couple days ahead of time. I really want to watch that. Or maybe I want to just get out now while I can, and then we'll see from there as far as whether you're going to go back in or not. So that's how the MACD is used as an early indicator on your moving average chart, moving average crossover chart. So are there some magic moving average numbers? Like when we talk about that, we're talking about time frame. Are there some magic ones, or the right ones to use, so to speak, or some better than others? And there may be some better than others, but there's no magic moving ones. Or moving average numbers. There's no magical numbers around that, or average or special time frame numbers. Someone says they know the best numbers or whatever, you might be, or they have a great system, you might want to be a little skeptical of that. But there are some common time frame numbers that are used a lot and are talked about in the media and all that too. So you will hear these over and over again, and there's one that really kind of stands out as far as something that's very commonly talked about. So it's good to understand what's going on with those. They're not magical, but understand that they're maybe highly publicized, and then how that can actually impact our investments, our securities that we're investing in. So if we think about the one that's really talked a lot is the 20-day moving average. And the 20-day moving average stands out because 20 days equals 1 month of trading days, if you look at a trading period. Now, a 20-day moving average, it could be a 20-minute moving average or a 20-hour moving average. Again, the time frames you can set based on your type of trading, how often you're trading. A day trader would have minutes and maybe an hour or hours versus somebody who's like me looking more at a month of trading days. But it's well known and it's observed by the trading community. So people know the 20-day moving average, and it's almost a self-fulfilling prophecy, right? So because everybody's talking about, oh, something's happening, it's coming close to the 20-day moving average. So when a security, let's say, is trending, it's common that the 20-day moving average will work like a support line. Sellers will stop selling it when it's reached. This is actually very common. It's like, oh, it's coming to the 20-day moving average. We don't think it's going to cross it. We think that's going to be more of a support line. So sellers will stop reaching and selling, and it'll actually intentionally bounce off the bottom of that support line and start going back up. That's actually very, pretty common. Less common is when the 20-day moving average, works like a resistance line at the top, where buyers stop buying when it's reached, whether they're waiting for it, to reach at that top, and they're like, oh, I don't think it's going to cross the 20-day moving average, so I'm going to now stop buying because we're coming up a resistance level. Now, if your charting and stuff has actual resistance and support levels, that's another thing, and maybe this is reinforced. But I think there's a little bit of self-fulfilling prophecy where people just believe these things, and they're like, well, okay, I'm not gonna sell when it gets down towards the 20-day moving average. But and I'm not going to buy when it gets to the top because I think it might break through that 20-day moving average. So not a magic number, but understand this is what you might hear in the media when they start talking about a security approaching the 20-day moving average. Now there are other moving average numbers too, and other popular moving average numbers includes a 5-day, which is like 1 week of trading, and 50-day, 100-day, 200-day, And why are these popular, right? Well, they're popular because they're round numbers. They're not magic numbers in any respect. At least the 5-day, you could say, well, equals 1 trading week or something. But they're not magical in any manner. But it does give the financial news something to talk about, and maybe make up, I don't want to say make up, but talk about things that when these things interact together with these kind of popular moving averages, like the dreaded, drum roll, dreaded death cross. Have you ever heard of the death cross? It's a real thing. And I don't know if it's not a real statistical thing, but it's certainly something they talk about in the media. So a death cross is simply when the 50-day moving average crosses below the 200-day moving average. That's the definition of a death cross, right? 50-day goes below a 200-day moving average. So we would know that would be kind of like a sell type pattern or a bearish pattern. Now, there's no statistical advantage over any other crossing pattern, and actually, since it's got longer time periods of 50 and 200 days, you actually are experiencing more lag, as we know from our previous lessons. But traders recognize a death cross. The media talks about a death cross, so it might be a self-fulfilling prophecy that, oh my gosh, the death cross is happening. We need to be aware of this, that prices are about to really go down because we're going to cross this death cross, or the death cross just happened. So this is a terrible thing. Same thing with a golden cross. So the opposite is when the 50-day moving average crosses above the 200-day moving average. That means prices are going to go up. So some would say a death cross means a wider bear market and a golden cross means a wider bull market. It does mean that a shorter term moving average has crossed a longer term moving average, and we know that means something, and people trade on that, and we can trade on that. But there's no guarantee like, oh, okay, things are going to get bad or things are going to get really good, depending on your point of view. If we looked at it graphically, by the way, this is what it would be, right? You get your 200-day moving average, and you have your death cross when it goes below, and you have your golden cross when it goes above, right? So that's kind of how that all kind of works. So it's the same thing. It's just the concept of, again, there's no magical numbers with moving averages, but it can be self-fulfilling as far as in the news media. But one thing with moving averages, to think about is they're really good, powerful indicating tools. And you can use them in different ways. You can use them as a primary indicator. You can use them to confirm another indicator. You can use them when prices cross above and below lines. You can use them when two moving averages cross each other. There are different ways to use them and different ways to incorporate them into our trading strategy. And they're very established, very well known. So that means lots of traders are using them, so it can be a little bit more predictive that way too as well. So use them with other indicators, but moving averages can be a really, really great way to enhance or be a big part of your strategy in terms of technical analysis. Now later we're going to talk about how to build these strategies and things together and how to pull these different things that you're learning about together into some coherent strategies and things, and also how to trade around these things as far as how much money to invest, all that. That's coming up towards the end. But for right now, understand that a moving average is an indicator, it's a tool, it's another tool in your toolbox, and it's a good tool to have, it's a good tool to use. So there are several different types of moving averages out there, and really the building block one is the simple moving average. It's the easiest to understand, and really the most common one that's used too. So let's look at that and how that's constructed and how we can apply that. So a simple moving average is basically looking at prices over a time period. So in this example, let's say we were looking at the price of a security over 20 days, and you can see the prices at 20 and 24 and 22, and you're going back, the most recent price would be 29 to the far right, and you go to the left, and the 10 days ago was at 20. So you do the average where you basically, this is a basic math problem, right? You add up the numbers, you divide it by 10 periods there. The average is 24.5, right? And then that's your average based on that time frame. And then on the 11th day, you now drop, your day one figure, the 20 unit, and you add in whatever the current one is, the next day's one. So on the 11th day, which let's say, for example, was 32. And you can see we now recalculate our moving average, and it becomes 25.7 would now be our average over that 10-day period. And you keep repeating the process, dropping, adding, and that gives you this range of prices, right? And that's it's a simple way of doing it. It's a simple moving average, and you're going to basically show a line, how it's going to be graphically and visually represented, showing these prices over time and how they change, going like from 24, then to 25, then it might go down or up, in this example here. And so if we look at like a chart, how this might look is here's our candlestick price chart here for Procter & Gamble, and You can see our candlesticks here and the prices, they're going up and they're going down, looking from the far left for farther back in time to the far right to the more current time frames. And so let's say we want to see a simple moving average. What would that look like if we applied it to this price chart? So what you do is you input some data so into your platform. Very easy. You just have to put, basically, one number basically, which is you have to choose what moving average you want and you have to input the time frame. So if we look in the upper left there, where I've inputted for a moving average or a simple moving average would be 50. That would be, let's say, 50 time periods. Let's say they're days. So that would be 50 days. And I put another one on the chart in pink for a moving average over 200 days, just to show the difference between them. So if we look at our price chart now, we see a blue line and a pink line going across it there. And you can see that the blue line, the more recent look back of only 50 days, is showing where it's actually crossing over some of the prices, where some of the prices, the most recent prices are above or below the line. And you can see if we average it out over 200 days, that never happens to cross over. Sometimes it can, it's just in this example, it's not. So if I look at this moving average, if I look at this chart now, I would say, oh, to the far left, there's not really much change. It doesn't cross the line. And then it starts crossing the line for us, the blue line, the 50-day moving average. And the 200-day moving average is just kind of off by itself. Now let's change the numbers a little bit and see how that might look a little different. So let's say I go in and I input and I change one of my moving averages to be only 10 days as far as a look back, and the other one, the pink one, to be only 30 days. What does that look like? And as you can see here, it looks quite a bit different, right? Now both lines are crossing over at points, crossing over where the price bars are, where the candlesticks are, and sometimes they cross over each other as well. And what does that mean? And that means something. We're going to learn about how we trade on whether these are crossing prices or crossing over each other is a key indicator we're going to learn about. But for right now, just think about when I change my inputs, what does that change to my simple moving average as far as the look on it? In addition, you can see how we were using candlesticks, but sometimes people like to look at moving averages with like a line chart. And here's an example here of the 50-day moving average over a line chart where the prices are more of lines as opposed to, candlesticks. Candlesticks can tell you a lot more, but sometimes a line chart is helpful just for you to see where the crossovers happen. So it can be visually kind of pleasing in that manner. And as you saw, we can decide to have more than one moving average on a chart. Usually folks will have one, sometimes they'll have two, but you can have more on there if you want as well. That's up to you as far as how many moving averages that you want to have. And that'll be impactful as far as when we get into how to really leverage this, which is with the crossover rule, which is our next lesson, when we're going to talk about, all right, this is great. We have these lines on this chart. Now, what does that mean and what do we do with them? And that's the next lesson. The crossover rule is a very well-established rule for decision-making, whether you want to buy or sell a particular security. And it involves moving averages and when they cross over things. So moving averages, lend themselves to really easily to understand and apply this trading rule called the crossover rule. So as prices move up and down, so does the moving average move up and down as well. And it lags a little bit behind it, but when they start crossing over, that means something's happening. And we want to make decisions around what might be happening around that. So let's talk about the crossover rule and how we can use these moving averages to help us make better decisions as far as traders. And the crossover rule is actually very simple to understand. So basically when you buy, when a price crosses above the moving average, so we have our moving average line, price crosses above it, that shows that that's a buying opportunity. Same thing with selling, where the price is going below the moving average, that's a selling opportunity as far as that. So let's look at that on an actual chart and let's see, well, what does that really mean? But really kind of remember when you're buying and when you're selling. So if we look at the chart here, we can see where the moving average, the blue line, happens to be a 50-day moving average, the one I happen to select. You can select different time frames, of course. And you can see where it crosses over the price line, the line price bar chart, basically. You can see where it crosses over. And really what you're looking at is you're looking for how this interacting with the moving average. So when it crosses above the moving average line, that shows that the trend, that things might be changing, a trend might be continuing, and the prices are going to continue to rise. By the same token, when the price goes below the moving average line, then it's showing that it's going to maybe continue on that downtrend as far as staying, prices either staying or going lower, as you can see in here in this example. So basically, a simple rule would be, and they don't stay there necessarily for long periods of time. Sometimes they do, sometimes they don't. I mean, if you look at the lines to the left on the far left of the chart, you can see they're well above the blue line for quite some time before they cross below, and then you would sell, and then above and buy, and back and forth, and kind of an up and down thing in the middle there. And then to the far right, you would see where you'd buy back in again. So really, if you apply the simple rule is, if it crosses above the moving average line, I buy, and if it crosses below the moving average line, I sell, is the idea behind it. Now, at this point, you might be thinking, yay, eureka! So simple. This is all I need to do. This is perfect. I just got to look at a line and whether it's going above and below the line. Okay, well, I'm glad you're happy. That's really good. Nothing's perfect, unfortunately, as far as within the technical analysis world. So don't rely on just one indicator, but it's a good, strong indicator, so you can be happy. Just don't be too overjoyous on it. So the crossover rule is really terrific. It's really easy to understand, and it's a really good, remarkably good predictable indicator, but it's not perfect. There are outliers, and you have data points that pull things far off of trend lines, and the more outliers you have, far ranges and prices, the less accurate your moving average might be, because those outliers are impacting that moving average. So it can give a false signal at times and give you a false signal of a breakout, but you can usually correct that quickly, because your moving average is going to come back down a little bit too. You probably saw in that last chart where it looked like in the middle there where there's a lot of up and down going above and below the moving average line. So it was a lot of buy, sell, buy, sell, buy, sell. And that's a challenge, and that's what's called a whipsaw, actually. And you can get with a moving average, and one of the downsides is you can get a lot of buy and sell signals with a frequent crossing period. Where traders are trying to make up their mind: do I keep buying, do I sell, as a massive group? And you can get these frequent buy and sell things, so you're doing more trading activity, which could potentially incur more costs as you keep buying and selling. And it can occur any time, but the most common time where you see a whipsaw is in what we call a sideways market. There's no definite uptrend, no definite downtrend. It's kind of trending in this kind of narrow band, and it's going above and below the line frequently, and that's causing this whipsawing effect of buying and selling. So it could lead to this frequent trading around that. So in the next lesson, we're going to talk about whipsaws a little bit more and how to kind of overcome that a little bit, but understand that can be a part of the crossover rule, but still a an excellent, very good rule as far as understanding when to buy and sell. So let's say we're experiencing these whipsaws with a particular moving average and a particular security we're looking at, and we want to try to reduce that a little bit. There's some things that we can do around that, and that's called we're going to talk about filtering and how to in other ways that we can overcome these whipsaws, and so you're making less trading as far as that might occur on these false signals going above and below the line, in a frequent manner. So let's take a look at that as far as overcoming whipsaws. And as I mentioned, you use filters basically to filter out, and get to valid buy and sell signals, and filter out the valid signals from the false signals. That's what you're trying to filter out, right? You want to trade based on something that's a real signal versus something that might be false. And so here's some filters that you can use around that. One is time. So the price has to, you could say, and basically have a time rule that says the price has to remain above or below a crossover point for a certain number of periods. And you can decide, 2 periods, 3, 4, whatever it might be. So you can put that in as far as timing, so you're not as frequently trading, because you've put in this rule that says, oh, okay, I've crossed the line, but I'm still going to wait 2 days to see, to make sure we don't have a whipsaw here, is the idea of putting in a time rule or a time filter. Another way you can do it is the extent, right? Looking at the price that's crossed that moving average line and say, okay, it's crossed it, that's great, but it needs to cross by a certain percentage. The price has to be either above or below the line by a certain percent, 2%, 5%, whatever the number you want it to be, as far as before I'll take action. Yes, the moving average crossing has given me an indicator. It's a strong indicator, but I don't want to have that whipsaw action, so I'm going to put in a rule as far as, when I'm going to buy based on how far above or below the line. Also volume. As we know, volume can be a strong indicator on its own, as far as really more of a confirming indicator, confirming what's happening. So you might say, okay, for the crossover, it has to be accompanied by a significant rise in volume. Again, higher volume, higher amounts of trading is more of a confirming indicator that what you're seeing is true. So if I see a crossover with very low or decrease in volume, I might ignore it. But if I see a crossover with a lot of associated volume coming with it, then I might use that filter and invoke it and say, okay, I'm going to do that. Or you could put in something like, I want to have extreme sentiment, right? There's an uptrend and I want to really confirm that's an uptrend. So not only does the closing price have to surpass it, but the low actually of let's say a candlestick bar has to cross it too. So like the bottom of the wick, the low part of the range. So not only has the price crossed it as far as the price at the closing of a trading day, but also in the trading range, the very bottom of the wick on a candlestick, the low has to surpass it too. So I'm looking for extreme sentiment that we have crossed this price bar, and that's really a true filter, a true indicator, and we're using this filter to really make it kind of do extra work to prove that it's really true. And then a downtrend, the high would have to, the top part of the shadow, the upper shadow, the top part of the wick would have to cross under the moving average, not just close, but you're looking at the wick and you're looking for it to cross as well in that range in a candlestick too. So I've put some kind of rules around this with these filters, whether it's the time, the extent, the volume, or I'm looking for the whole trading range to cross over, not just the price, to put in more things to make me make a buy or sell a decision based on a trading rule in addition to the crossover to overcome these whipsaws. Now you probably are already seeing maybe a little bit of some of the downside of filters, right? So filters will help with accuracy. You'll do less trading, but they can and they'll help reduce whipsaw losses. As far as again, so you're not frequently trading or trading in the wrong way. You're putting these stronger rules. But filters also increase the lag to an already lagging indicator, which can reduce profits. So if I say I'm not going to buy into something until it's, let's say, 2%, not only cross the moving average, but it's got to be 2% above the moving average. Well, now I've added another maybe indicator or added more lag to it, where I could have bought in sooner, but I want to at least make sure it's above 2%. So I just cost myself 2% in that example. So you can apply these filters based on your trading style and your feelings around risk aversion too. Somebody who has very low risk aversion, really wants to take a lot of risks or whatever, they'll have very low, if any, filters. And others are like, no, I want a little bit more of a perfect setup. And so I want to, I'm going to have maybe even more than one filter, maybe another confirming indicator before I make a trade. I'll make less trades that way, but I know when I do, I'll feel a lot more confident on it. So if we look back at this chart again, you can kind of see where these whipsaws come. And you can see if I'm entering into this or I start following this particular security, and I say, oh, okay, if I come in at any point and I'm above the crossover line, well, I could be buying, right? I might want to look at other indicators, look at trends, all that stuff. But right now I know, at least as far as in this case, a 50-day moving average, I've got that long stretch where I could have bought at any point of that. And if I bought at the beginning at the far left, boy, look at that nice run up I had in this security just by holding it over this period and then selling it once it came down to crossing below the moving average line. Then we enter into this period of whipsaws, right? You see the sell, buy signals again, going back and forth. And we see us crossing below that last moving average line there where I have the red arrow. And you can see where we're definitely in more of a sell period or don't buy period until at the very, very end, you see it kind of cross above too as well. So you can see if we filter out these whipsaws more, then we would have less of that sell, buy, but we might also miss out on its potential opportunities too. So just a way to look at it, but understand that the moving average rule by itself is a very, very good and very strong indicator. Another rule that you could use with moving average lines is the moving average rule is what it's called. It's an alternative to the more popular crossover rule. So you're not looking for when it crosses over, you're basically looking for when the moving average starts to bend or change. So you would look at it to call an end to a trend when you have changes in actually the moving average line. Instead of uptrending or downtrending, it's starting to make that change either way. So if there's an uptrend, if the moving average is less than today's moving average is less than yesterday's, you could start calling an end to an uptrend with that, and the opposite, of course, would be in a downtrend. It's been downtrending if the moving average today is higher than yesterday. So you're basically your most recent data point, and then looking at your overall trend. And so the advantage of this is you're not looking at crossovers, you're just strictly looking at the moving average line over the period of time. And it helps as far as you can call an end to a trend faster than with the crossover rule. Moving averages always are a lagging indicator, but you're able to kind of see where that change is occurring on the line as opposed to waiting for crossovers and prices is what you're looking to do. It still suffers from lag, it still suffers from whipsaws, but it is an alternative, and you can use some of these filters we talked about as well to establish filters or rules around that as far as using this without the crossover of the price, but looking at when the, basically when the moving average itself starts making some changes. If we looked at this graphically, you could see here, you can see how it's kind of in this curve, right? It's this particular moving average, they can look different than this, but as you look along the curved line, you can see as it starts to flatten out over time, you can see that's, when the moving average is starting to change. And you can see up in the upper left there what's a 50-day moving average, and the moving average is at $138.95 in this example. So when you start seeing, things that are coming up less than that, then that might, signal a change in that upward trend that we're generally seeing with this thing. If we start seeing that number going down, that might, show a downtrend there. And as you can see, depending on the length of time here in this graphic that you choose, you have a 50-day moving average and a 200-day moving average. And of course, the longer the time period, the prices will differ too. But if you look at the curves, you can see where the top line at the far right, you might see it more of a downward trend on the far right of the blue, where the right is actually starting to trend upward, a little bit of an upward trend as they start to move towards each other. And so that's kind of giving you kind of conflicting messages, right? And that can happen. So, that time frame length can really impact that. The more time you have, the more the decision would be delayed as far as making a change. And you want to take that in consideration. And again, you can use this with other filters. You can use this with other indicators to, decide what you want to do. Personally, I like the crossover rule. It's much more established. And also, it just seems to be easier to comprehend, easier to see too, than just, but if you want to look at something where it might, indicate that the trend is changing sooner, you can use this moving average and just look at the moving average itself and not really looking at the prices. So with our discussion about moving averages, we've been talking about the simple moving average, sometimes shown as SMA on a chart, the simple moving average. And but there are other moving averages that you could use as well. And so there's a weighted, exponential, adaptive. These are the main categories of moving averages beyond the simple moving average. And they work in the same manner as far as like price crossovers and all that. But let's say you want a moving average that's more reflective of the most recent price. We know a simple moving average is an equal distribution between that price range. But it could make sense where you'd be like, I'm more interested in what's happening more closer, more weighted towards more recent pricing. So, you might think, well, I'm not buying 200 days ago. That's maybe too much of a lag. I'm looking for something a little bit more, and I want to use a weighting average that might take advantage of that. Now, a couple ways you could do it. One is you could just reduce the number of days in the simple moving average. That would give more weight to something that's a 10-day simple moving average gives more weight to 1/10 versus, let's say, a 50-day moving average where it's 1/50th. So you'd have more weight towards that more recent pricing, or more weighting really with all the pricing over that time frame. But you can also use moving averages that actually intentionally put more weight on more recent days. And that's what we're going to talk about here for some of the ways that you can do that, or basically moving averages that you can choose to use if you like to do that and want to put more weight on it, which makes sense as far as doing that. So the first one we'll look at is, think of like a weighted average, right? And when we think about weighting averages, we could look at prices over, let's say, a period of time. Here's an example, just from the math standpoint. This is over 5 days. You can see the prices. The furthest back price was $20 or rupees or whatever units you're using, and the most recent one is 31, and then there's a 33 there. So you can see, the more recent prices are much higher than the ones further back. Now the simple moving average, or the simple average on that, would be 26, right? You have your 130, add them up, divided by 5. Now a weighted average would put a weighting factor towards those numbers, basically. So the ones that are most recent would have a heavier weight to them than ones that are further back. So if we look at that first bullet point there, you can see the 20, say, dollars has a weight of 1, whereas the 31 has a weight of 5. And you do the math, 31 times 5, and you can see the math there, how that breaks out. And then you're going to divide that by not the, you're going to break that out not by the number of days, but you're going to break that out by the weights, the number of weights. So it wouldn't be 5, because that would be a simple average, or you divide it by each of those weights, 1, 2, 3, 4, 5. If it was 20, it would go up to 20 different weights. And thus, mathematically, you would actually weight the more recent time by dividing 421 divided by 15. In this case, doing the simple math part, or the math part, would show that our weighted average would be equal to 28, 28.06 to be exact. Now here's the good news. You don't have to calculate any of that when you're trading or working with your trading platform. You just have to select that you want to use a weighted moving average as opposed to the simple moving average. But I thought it was important to understand that how it kind of works mathematically, that they are putting more weight on the more recent days when you do a weighted moving average. Another one that's very popular is an exponential moving average, where it puts even more weight to recent days. So the weighting given to the most recent price is greater for a shorter term extended moving average, or EMA, than for a longer period EMA. So for example, they might apply multipliers. So if let's say an 18.18% multiplier is applied to the most recent price data for a 10-day exponential moving average, then for a 20-day EMA, that would be 9.52 as far as the multipliers that they're using. Again, you don't have to calculate any of this. This will all be done automatically for you, but think that simple moving average is an equal pattern, equal weighting. Weighted moving average weights the most recent days heavier. Exponential weights the most recent days even heavier still than a weighted moving average. So if we looked at this on a graph, for example, we'll take our graph we've been looking at, our chart we've been looking at, and you can see I've got the moving average over a 50-day period. That would be a simple moving average. And I have an exponential moving average of 50 on there. So it's the same time frame, but you can see how they might differ as far as, in this case, they only differ slightly in terms of the price. Sometimes, and especially if you use different time frames, it could weight it even higher. But this way you can see as far as, the different weighting, or you could use a different type of weighting around that and weighting more recent prices versus prices longer back. You can even see how they even cross over at times too. Another one is an adaptive moving average, which is kind of a push and pull aspect, where it's looking at a short time frame to identify the beginning of trends quickly, and as long as necessary, you want to kind of construct it to avoid constant buy and sell activity or whipsaws. That's where these adaptive moving averages came in. Because with any of the other ones we talk about, you can still have that frequently trading whipsaws. So sometimes you might want to adapt it to a smaller number of days, and then sometimes to a higher number of days, but you can kind of play around with it. But you don't want to force it, because you're not sure which is right as far as the right days. So adapting moving averages uses, calculations, complex, and it's all automated calculations, to do this by detrending the series to make the current price most important. So it's not so much weighting as it's actually detrending, whether it's up or downtrend. It's actually adjusting the trend in the series of numbers is what it's doing with an adaptive moving average. So there's some complexity behind that. What you'll see on trading platforms, and probably the most popular one of this, is the Kaufman Adaptive Moving Average, or you'll see it listed probably as KMA, named after a gentleman named Perry Kaufman. And what it'll do is it'll closely follow prices when the price swings are relatively small and the noise is low, right? So it's kind of adjusting for that. And it's got a complex formula, a lot of multiple layers on it, and they actually have some recommended settings. Sometimes you can change the settings, but they have recommendations around those settings. For 10 being the number of periods, 2 the number of periods for an EMA constant, and 30 the number of periods for a slower EMA constant. Those would be the traditional numbers you'd enter in 10, 2, and 30. If you choose a Kaufman moving average in your platform, it'll actually prompt you for that. I have a link there if you want to really learn the whole math behind it. You can kind of find that out as well. So here's an image or a chart here where it's showing that the Kaufman moving average is looking that when prices spike there, it actually smooths it out even more, and you have that downtrend kind of coming down. And then when the prices turned up over 50%, then it really started to impact it more. I see is where it's weighting that more recent price changes versus an outlier. It's more weighting a little bit more of a longer part of that of that average with an adaptive measure is what it's doing. So with each of them, they all have their strengths and weaknesses. Simple moving averages would be the easiest to understand, and most commonly used. Weighted moving averages, you know, they're weighting those most recent date. Exponential takes even more weight on them. Kaufman tries to use some more complex formulas around that, you know, as far as, you know, the different types of moving averages. So when you're looking at moving averages, you know, that's one of the considerations you want to think about is which one you want to use. There's some other considerations too, which we're going to talk about in the next lesson. So many people in technical analysis love using moving averages, and they're very, very commonly used, but there's a lot of big debates around them. And one of the biggest debates around them in technical analysis is which one do you use? And they really kind of come around two big aspects of it, which is the aspects you need to choose when you're choosing to put a moving average on the chart or on the security you're looking to evaluate. And so you need to think about the type of moving average you want to use, simple or weighted or exponential or adaptive, whatever it might be. And then the length of time, the period of time, those are the two things that work together that you get to choose from. So let's talk about that a little bit more. So we think about it, you know, what's most sensitive to recent price moves, if we were to kind of grade that. Simple moving average, or SMA, would be the least sensitive, and then weighting moving average, and then exponential, and then something like a Kaufman moving average would be more sensitive to recent price moves. So that's a way you can look at it. For one thing, how much you want to put most emphasis around recent price moves. The other would be the time frame. You know, how long of a time frame do you choose? The shorter the time frame for your moving average, it's going to respond quicker to new conditions, right? But in a longer time frame will reduce errors, basically reducing whipsaws, right? You know, basically going in and out. So if you want something that responds, you know, quickly and is very sensitive to prices, then you might use an EMA with a short time frame. If you want something that'd be less sensitive to most recent prices and over a longer period of time, then you might use a simple moving average with like a 20 or 50 or even a 200-day time frame. And they all kind of work, and they all work in their own ways. But that's the big thing you want to understand is sensitive to recent prices in choosing the moving average, and the time frame as far as, you know, how quickly they're responding. Shorter time frames, more responsive as far as that would go. Now here's the deal with moving averages. They have limitations. They're very useful, but they're not perfect. You know, nothing's perfect, right? But they can be used really in conjunction with other types of indicators as well, as far as a really good confirming type indicator or working as a pair. And some of these challenges, though, are harder to overcome than others. So let's take a moment to talk about some of the limitations of this. They're good, but let's talk about some of the limitations and some of the ways that we can overcome them. We talked a little bit about filters with the simple moving average. Let's talk about some other things we can look at as well. Now, one of the limitations of moving averages in general is when markets go sideways, right? There, you can almost see from the image there in the circle where it goes up and it goes down, up and down, up and down, and it's kind of going the sideways thing versus a definite upward trend or a definite downward trend. Moving averages are better that way. They struggle a little bit more when there's no trending or they're moving sideways. It makes it harder to predict the next move, and that's where our whipsaws come in, right? They're frequent price changes above and below the crossover line, giving us different, you know, buy and sell signals constantly, so we might be, you know, forced to trade more often unless we filter that. The value in a sideways movement is you can recognize that is to recognize that it's occurring and then adjust or wait for a trend to appear, or you can use other tools with the moving average to identify actions to take, like looking at support, resistance levels, different things of that nature. But understand that a moving average can be a little bit more limited in a more sideways market. If we look at this image here, you can see where there's a definite uptrend in the blue and a definite downtrend in the right. And then we see the sideways trend there in the middle where it kind of is bordered between the two, the top and the bottom on that. And then, you know, using things like our chart analysis, we can identify that it's a channel, and we can sell near the tops of this channel, for example, or we could buy near the bottoms of the channel. This is our resistance and support lines that you see that we've driven over the top of it above these prices. And then if we look at the moving average overlaid on top of that, maybe we could also look at, to be even more comfortable, we could say, well, we're going to sell near the top of the channel, expecting it to come back down. And then when it comes back down, maybe we've sold at the top of the channel, but if we're not sure of the channel, we would certainly sell after it crosses that moving average line. And then as it gets more near the bottom of that support level, then we might buy near that bottom as opposed to, buying, or we could wait until we bought, after it crossed the line again. So you can kind of see where, they can kind of work together, these different channels and moving averages. And there's different times when you'd be buying or selling, whether you're moving quicker on something like that or slower on something like that, depending on the channel and depending on the moving average. Another limitation dealing with moving averages is noise, right? If you have a disorderly chart, there's lots of outliers, right? So it's kind of noisy. You have spikes, or you have high prices, low prices. It doesn't seem to be really, very organized as far as a chart, or a noisy chart. And you can give off more false buy and sell signals, right? It's going above and below the line, whipsawing a lot. It just seems to be all over the place. And you can fix that by applying a moving average with more days in it. So things that are these big outliers can get smoothed out more and become less of an outlier, because a longer time frame will actually smooth that out more than a shorter time frame. However, a longer time frame will increase the lag a little bit more. It doesn't put as much emphasis on more recent prices. So it's with all these things, you have kind of a give and take around that too. But if you're dealing with a chart that seems just real confusing, highs, lows, all over the place, and you want to try to get a feel for that moving average, try a longer time frame to give you a little bit another way of looking at it, understanding though that it might increase the lag. And then if we look at lag itself, that can, of course, is a limitation. And you could see a dramatic price move, and you could see potential profits. Like, look at where it went. It went way down. There might be a way to buy in, and then there might be a good opportunity here. But you're, let's say you're a disciplined investor. Hopefully you are a disciplined investor, and you decide you want to wait a few days for that lagging moving average to catch up and then actually create the crossover. So you can see it kind of happening. You see it kind of moving towards the line, the moving average line, but you're waiting for the crossover to happen, which is your way of confirming and your way of making that decision around that. And if you put an extra filter on, like it needs to cross the line by, like, say 2% or 3% before you actually make a decision, let's say to buy, for example. Meanwhile, while you're waiting for that kind of lag, you could be losing out on profits waiting for that to happen. Now, the nice thing with technical analysis, you don't have to be perfect. You don't have to be perfect every time. But understand there's an opportunity cost, where you might be delaying to avoid the whipsaw and avoid frequent trading, but you're experiencing that lag. Now, you can fix that by applying a moving average with less days in it. So it'll be more sensitive to that recent price, or you put maybe more of a weighted moving average with less days, then it's doubly sensitive to a more recent price, and so you're trying to reduce that lag a little bit as far as your trading decisions go. But if we look at some of those things, you can see the conflict. I hope you saw the conflict there right away. If not, let's talk about that. You have noise and lag, right? And noise you fix by applying a moving average with more days in it. And then lag you fix by applying a moving average with less days in it. So you kind of have to play around it, especially as you learn certain securities, what might work best for that particular security. But you can see there's a yin and yang here. You're by giving up one, you're getting more of another. So unfortunately, there's no magic number of days, right? I wish there was a magic number. I would say, well, the best number to reduce noise and lag at the same time is this number of days or number of periods, depending on could be hours or minutes, let's say, if you're a day trader. So there is no actual, perfect one. Some are, might work better than others, but there's no perfect one. You just have to adjust and understand, noise and lag. Alternatively, what you could do is just focus on a security that's more orderly, or in effect less noisy, has less of these outliers and things, so it's a little bit more orderly. So if you have less noise, you can kind of work on that lag part a little bit more and use a moving average with less days, because the security is moving in a more orderly fashion. So that's another way you could do it. And then there's another option which you could use multiple moving averages as a strategy. And we're going to talk about that next here. And so we're going to talk about that strategy where you're not looking at when the price crosses over and dealing with that limitations. You're going to look at when moving averages cross over each other. So let's take a look at that here in the next lesson. Another effective strategy is not to really even look at the prices really at all. You're looking at the moving averages and how having more than one moving average and how it interacts with each other. So you're looking for price crossovers. You're actually looking at moving average crossovers. So how that kind of works is you have one chart, you have your chart of your candlesticks, your prices, whatever is going on there. And you're using, a moving average with different timelines. You could even have different types, or they could be the same type, but they definitely have to have different timelines as far as, days, minutes, hours, whatever your time frame is. And what you're looking for is not that the price is going to cross that moving average, but that a shorter timeline moving average is going to cross a longer timeline moving average. And we'll have some graphics here. They'll show that in action and what to really look for. But think conceptually like not about price, two moving average lines, and then they're crossing over themselves is the idea. And then what do? Do you buy or sell based on that crossover is the idea. And we're going to talk about that. So for example, a real common way to do it, or combination, is have a 5-day moving average and a 20-day moving average is a common combination. You can see they're shorter time frames. And as an effect, you're comparing 1 week of prices, 5 trading days, and 1 month of trading, trading prices, or, 4 weeks times 5 is 20 days as far as being open, markets being open, closed 2 days a week, open 5 days a week. So that's a common way where you're looking at a week versus a month, and are they crossing over? However, you can choose and experiment with your own timelines, and that's perfectly okay. A lot of people use 50-day versus 200-day moving averages. There's lots of different ways you can do it. But a common one to get you started is like a 5-day and 20-day moving averages. So what you do is when you buy, when the shorter time frame moving average line crosses the longer moving average line on the upside. So you've got this longer moving average line, and the shorter one is crossed above that line. So by the same token, you sell when the shorter moving average line crosses the longer moving average on the downside. So it's going down below it, so you've got the shorter one is going to go below the longer one. And then the buy, of course, when the shorter one is going above the longer one. So let's look at this graphically so it makes a little more sense to us here. So if we look at this chart here, you can see we have a 5-day moving average in the blue and a 20-day moving average in the, we'll call it pink here. And you can see, let's go over to the far left. You can see how we have a real strong uptrend here on the far left. You can see that 5-day moving average prices, again, very sensitive because it's not a long time frame. Even though it's a simple moving average, it's not a weighted moving average, but you can see how it hugs to the prices. Versus the 20-day moving average, there's a kind of a gap between that blue and that pink line on the far left. And then you see them start to come together here in the middle where it's almost hard to see, but you'll see that blue line cross, a little bit, or start to cross below that pink line. Those are sell indicators that, we might be a little bit of a downtrend or an opportunity to sell, that we've topped out, and we're actually in a more of a sideways market, and it's kind of whipsawing a little bit there. But that would be our sell signal that the blue line, the shorter time frame, is going to cross, above and go below. It's going to go below the pink line. And then as we go a little bit further on, you're going to see a definite uptrend come again where that blue line 5-day is going to cross that 20-day, definitely cross it and go above it, and then keep going above it, and that would be a buy sign. And then so on and so on as we go across the chart. You can see the lines crossing each other, and each time there's a cross, that means that there is either a buying time or a buying indicator or a selling indicator as you go through those. And I've highlighted those here. You can see, where there's a sell, a buy, sell, buy, sell, buy, as far as looking at those when they cross over and when they go back up again. Again, if you have longer, let's say instead of a 5-day, I was using maybe a 40-day or 50-day moving average for the pink line, there might be less times where they might be crossing. So that's where you can, adjust those to see what's comfortable for you. But this is a classic way to do it, is with a 5-day and a 20-day, and you're looking for when the lines cross over. And this has nothing to do with the prices. You're looking at just the blue line and the pink line. It should correlate a little bit together as far as with the prices, but you can kind of see you're really looking at the lines more so than prices by looking at moving average crossover versus price crossing over a moving average line. In addition, if you see more space, or what you call daylight, between the two lines, you'd have more confidence that the signal is correct. So if we look over in the far left, or you can see where the arrows point, and the other two areas as well, there's a lot of daylight, a lot of space in between the blue and the pink line. So that gives us a confidence that, okay, this is pretty strong. It's going to probably keep going on that uptrend there, for example, on the far left. And so we feel pretty good. Once there's less daylight, which you can see in the first cell box, it starts to get all kind of messy there, all close together. Then there's less confidence that that sell signal is correct. That's not just going to whipsaw and go back to a buy signal. And then after that second buy signal, we see another big gap come up, and so we have a nice another run up in this particular security, where we can have confidence that that signal is correct, and then so on throughout the rest of the chart. So when you're looking for things with moving average crossovers, look for the crossover, but also look for looking back over time, how wide that gap is, how much daylight is there between the two lines to give you, another extra level of confidence that you're making, the correct move on that. If we were to, let's say, lay on 3 moving averages, and let's say we wanted to have this almost be a filter where we're like, yeah, 2 crossing is good, but we want to make sure that all 3 are crossing to be really extra sure, you could do that actually. You could say, okay, I want my shortest time frame. It'll always be the shortest time frame. And let's say I've got the blue in 5 days, the pink in 20 days on this chart. And then I've added a moving average, a simple moving average of 60 days, right? So you can see to the left how there's a lot of daylight between the blue and the pink. But if you look between the blue and the pink and the green, there's a lot of daylight even between them. And you can see how if we follow that green line going up and where that blue arrow is saying approached but did not cross, you can see we go all the way across that chart for a long time frame before we actually cross all 3 lines, really somewhat significantly where we're crossing all 3 lines where the blue line is in effect crossing the pink line and the green line, those longer moving averages that are telling us a real sell signal. So if we did it this way, you can see how it takes out all that whipsawing that occurred earlier, that above and below the line, took all that out, and we've been holding the security all the way until we get to that sell part, and then we sell from there. And then as we get to the far right of the chart, we're waiting for a buy sign where it looks like on this chart, the blue line, the short time frame has crossed the pink already, but we're waiting for it to cross that green one. And once it crosses that green one, then we're looking at another buying opportunity. But right now on this chart, long time we've held this particular security, we've sold it, and then now we're kind of watching it to see if there's an opportunity using 2 moving averages crossing each other for another buy opportunity, or if we just should just stay out of it. Another thought too is if your trading platform or software allows, you can even put more than 2 moving averages on there, or 3 or 4 or however you want. You can even go up as high as 10. Depends on the trading platform. A lot of them top out at 10 or at 3. But if you can allow to put a whole bunch of them on there, then you'll get kind of this colored line effect that'll kind of create like a rainbow. So your shortest time frame is going to kind of move through the rainbow, and some people like that. But again, if you put on a lot of filters, you're going to have less trading opportunity, which might be good, certainly limiting whipsaws, but you might be giving up an opportunity when maybe you should have got out sooner, or you might miss a buying opportunity on the upside. So traditionally it's 2 moving averages, the shortest one crossing the longer one, but going 3 adds another extra layer of filtering basically on that, and gives you a little bit more confidence. And don't forget that length between the daylight here to give you more confidence too between the lines. Let's talk about some more helpful tools, and they revolve around momentum. Momentum helps overcome one of our biggest challenges in technical analysis, and that big challenge is detecting when a trend is about to end, or is it a minor pullback? Is the trend ending, or is it really just kind of a minor pullback or minor temporary change and the trend's going to continue? Momentum tools are terrific at overcoming that challenge. So let's talk a little bit about the basic concepts of momentum, and then we're going to share some specific tools that help you later in this section as far as around momentum. So what momentum is at its basic level is it really looks at the speed of a price change. So it's actually relatively easy to calculate. It's all going to be done for you by your platform. But if you think about it, you're looking at the speed of how fast or slow are prices changing. So it looks at basically today's price, what you could pay today for a security, and what was that price X number of days ago, or periods ago, hours ago, minutes ago, whatever your number of periods are. You're going to compare those two. And it's going to really look at a rate of change, or a rate of change method, that applies some, simple mathematics and percentages around that. In fact, when you look at momentum on your platform, it might not even call it momentum, it might call it ROC, or rate of change. So for example, if prices are rising fast, the momentum number that you can use to kind of use as an indicator is going to keep getting bigger. And on the chart, a momentum chart, and we'll see some examples of that in a moment, or later in this section, on the chart, it's going to show a rising line, right? So if you see a rising line, that shows prices are rising fast. If the prices are rising, but they're not rising so fast, and the line will start to flatten out, right? So you're going to see that line not be as steep. It's going to start to flatten out as prices maybe are rising, but they're not rising that fast. So momentum is all about the change in price level rather than the level itself. So it's not about the actual specific price so much. What you're really measuring is that change in that speed of that price level. So you might say, well, that's great, but we want more. We want even more. And it does quite a bit more. It will measure the amount of that acceleration of that price change or deceleration of that price range, depending which way you're looking at it. And then also the amount of that rate of change. Momentum indicators also will eliminate as much noise as possible by looking at those changes. And you can kind of see momentum in the context of an overall price range, that highs and lows, what's momentum doing, what's happening, are prices accelerating, all that kind of stuff. And it can really, really give you a good indication of whether a security might be overbought or oversold situations. Overbought where it's pretty much everybody who's going to buy it at that certain price level has. You might be ripe for a time for it to kind of go backwards or go on a downtrend, or vice versa, where it's oversold, where it's just price has been really pushed to the bottom, maybe real quickly pushed to the bottom, and it's really ripe for a turnaround, and it might be a good buying opportunity for you. So it's an indicator that can really help with that. Is a momentum indicators that we have here can be used really well for that. And a lot of people like to use momentum really more so as a confirming indicator. I like that idea too. So if you're evaluating, it helps you to evaluate the strength of a trend that maybe another indicator is saying there's a trend. So your primary indicator is saying there is a trend, whether it's up or down, there is a trend. And maybe it's something like the confirming moving crossover or price, moving average crossover, whether it's price or the two crossovers crossing over each other. You could say, I think there's a trend here. I'm seeing a price crossover. I want to confirm that with this momentum, with a momentum indicator to see if this is also saying that we might have, a situation for a good opportunity to buy or sell by looking at that price change, acceleration and deacceleration. So that's kind of momentum in a, kind of the basic math concept and what it does, measuring that rate of change. And then from building from that basic core foundation of the momentum calculations, there are some powerful tools that have been built on top of that you're going to see in any of these, platforms as far as for trading. And what you really are going to use is these types of indicators. And the two really that stand out are the RSI, or relative strength indicator, and the stochastic oscillator too, which sounds like a fun name, doesn't it? So those lessons are coming up. But those are the key things that build on top of the idea of using momentum to analyze from a technical analysis standpoint, securities. Oh, let's take a brief moment or pause here to talk about the difference between momentum as a technical indicator and momentum investing, because you might have heard the term, that person's a momentum investor, for example. And they're two different things. So let's talk about that briefly. So momentum at its core is an arithmetic calculation, that technical traders are using to, as we talked about earlier, to identify the speed of change in the speed of a trend, or looking at a trend and how much are those price changes going up and down, accelerating, decelerating. It's a technical tool that we're using to really identify that. Momentum investing, as opposed to that, is really about buying a security, and it's an investing strategy just because that security is going up without actually measuring things like the rate of change or using possibly even any technical factor at all. So it's more of a strategy of investing. And the idea behind the strategy is that, well, if something's already rising, the idea is that it will keep rising, or at least for a little bit longer. It's got that momentum behind it. It'll keep rising, for example. Or if the momentum's going downward, it's the same thing where the momentum will be going downward. But you see the difference between the two? In technical analysis, momentum is a calculation, unemotional, just this is what it's saying, this is what the math is saying, and we're using that as an indicator to make buy and sell decisions. Where momentum investing is more of a strategy of like things that keep going up, especially that type of momentum that will keep going at least for a little while, but it doesn't get into any kind of technical trading. If you could actually be a momentum investor and then try to use technical trading to identify that sell point, might be a way to do it, but they are two different things. So if you're thinking like, momentum means I'm going to be a momentum investor, not at all. It's a tool that you can use with any type of investing strategy or trading strategy, and just think of it more so as in a technical analysis aspect, that momentum is a tool to help us with our trading. Okay, now that we understand what momentum is, let's now see how we can use it as an actual trading indicator and where we can recognize buy and sell signals around that. So it's actually very simple to use and simple to recognize, which makes it a nice indicator. It's always nice to have indicators that are visually appealing and really helps to, kind of confirm or strengthen your choices. By the way, if you're using a trading platform, a lot of times they may not list it as momentum per se. They might call it rate of change or an abbreviation of ROC. So if you see ROC, that's momentum. That's the classic momentum indicator. We're going to learn later about RSI, relative strength index, and Scholastic oscillator, and other types of momentum indicators, but this is the core kind of basic one that everything kind of builds from. So let's learn about that and use it as a trading indicator. So when you're looking at the part of a chart that you would add on to your regular price chart, actually, usually it's on the top or the bottom when you add it onto your price chart. And you would see like this kind of a little breakout, and it would look a little bit different than your regular price chart. I don't know if you're already looking at and see how it might be a little different here, or looking at Tesla and Procter & Gamble as a couple examples, and you can see they're different because they're different stocks, of course. They're different securities. But if you look at it, you'll see that the time is still the same. The oldest time is to the left, going to most recent time to the right. But if you look on the right-hand side, what is represented is not price. That's a real important thing. Tesla is not selling for, at this point, $35.94, and Procter & Gamble's not at 76 cents. So what it is, it's not a price, it's a percentage. And you have a zero line there. You see the zero line. And if you're above and below, it's a percentage above and below that price. And that will tell us things as far as being above and below the price. So if we looked at Tesla there on the top, it's at 35.94%. And then we're using as you see in the upper left where it says rate of change, or ROC. So as I was mentioning, that might be what you will find on your trading software. We have it over 10 periods, which is a standard for using for momentum as far as over 10 periods. And so you might be thinking, if you start looking at this and say, okay, what might be important as far as deciding whether to buy and sell, hopefully you're looking at it and you're thinking, oh, maybe that percentage is important. How big the percentage is important, but really what might be important is whether it's above or below the zero line. Is it a positive number or is it a negative number? And if you were thinking about that already, great for you. If not, let's talk about that, because you're right on. The zero line equals the price basically X number of periods ago. So in this example, we mentioned we were looking at 10 periods. So the zero line indicates that will give you an indication how much above or below that percentage was 10 periods ago. So again, we're looking at acceleration, deceleration, we're looking at momentum. Again, not price on the right-hand side, it's a percentage. So you see it's a 35.94. So the signals that you want to be watching for, and where it makes it visually appealing and easy, is it's a buy signal if it crosses above the zero line. It's part of signaling an uptrend. So if you look at Tesla here, you can see it crosses below and above the zero line, several times or a couple times, but mostly it stays above that zero line. So if it crosses above the zero line, it's an uptrend signal, and it's a buy signal. You'd sell if it crosses below the zero line. So that's basically signaling a downtrend. The percentages up or down or show you the strength around that momentum too. Something that just barely crosses over that zero line, shows that it's an indication you might want to buy if it's going above it, for example. But it's the strength of it, if you wanted to wait to see, make sure to kind of confirm and let it be stronger to build out, higher above that line would show you more of a stronger number around that way. If we look at it, it's pretty simple, but if we look, sometimes it does diverge, where momentum and price move in the opposite directions, maybe ever so slightly. So if you see that, technically both are going in the same direction, because momentum is really measuring speed. It's more failure to confirm the price move if it's going a little bit in the opposite direction. So if you see this here in this example, it's above the zero line, which is a buy signal, but it's just headed the opposite way slightly. If you look below to the chart, you can see where we've got our candles. Just slightly different. Might start be going sideways in the price chart, and you can see the momentum indicators kind of going along with it too a little bit. It's not a huge example, but it gives you an idea of what it might look like if there was a divergence going on. And you can also see that the volume in this example is really steady or low. So that's, remember, we would think of volume as a way of confirming things. So if this was a definite crossing below the line and volume was high, this would be an example, or rising maybe, and this would be an example where, oh, that sounds like a pretty strong sell signal. Where this might not be as strong a sell signal, or a change, going below the line. And as you can see, it kind of ticks back up a little bit, as far as going up on a little bit of an uptrend after we get outside that little red, rectangle bar I highlighted. But then it starts going down from there. And as you see it go down to the right, you'll see how it's now crossing below the 0 line up above in the momentum indicator. And that's what we're looking for, is when it crosses below, we want to sell and get out before it goes down further, is the idea. Here you can actually see there's a breakaway gap in here. I'll take, you can see the breakaway gap. It, as we remember from the gap lesson, it jumped way up as far as price, overcame the range of the previous, in this case, days. It could be minutes, hours, whatever your trading range is, but this is days. So you see it had a breakaway gap that was then reinforced with a little bit of a pullback there after 2 days, but then only for a couple of days, and then a strong trend going forward. And you can see how that the momentum indicator crosses above the 0 line right around that same time and then starts reinforcing that. So that's another way you can use to help reinforce that maybe your breakaway gap is really something that's going on. In fact, if we look at it a little bit closer here, you can see that not only is the momentum kind of confirming it, but also we have our volume as another confirming measure. So we can look at this and apply some of our different lessons and say, I've got a breakaway gap. I waited for it to develop, because you want to make sure the trend develops. I did that, so hooray for me, or for you. And the momentum indicator is rising above the 0 line, then certainly going well above it, so it's kind of confirming that. And the volume going from some very, very low volumes right before it kind of confirmed it. So if you see that, you've got really basically 3 indicators kind of confirming each other, particularly on something like a breakaway gap, which we know breakaway gaps are designed to lead to higher strong trends, right? So that's a strong indicator showing a strong trend going forward. So at this point, you should be very happy. Yay! That's a good strong indicator confirmed 3 ways. Again, nothing's perfect, but that's a really good strong indication you would have came across, confirming it with multiple different things beyond just the breakaway gap, which might have been your primary indicator. So momentum is pretty easy to recognize on a chart, but there are a couple little things to understand and a couple little tricky things too, just to be aware of if you're using a momentum indicator. And you may think, well, when the momentum line is horizontal, you may think that momentum has stopped, that it's basically stopped in its tracks. And that's actually not so. It's actually the acceleration has stopped, or it's starting to slow down, and it's going to accelerate or deaccelerate, or it's deaccelerating, and now it's going to accelerate maybe in a different direction, possibly as it flattens out. It might go up or might go down. But it hasn't technically, the price hasn't stopped or the momentum hasn't stopped. And that's the other thing. When you look at momentum, your eye will naturally line up with the price. It's okay with that. We did a little bit of that in previous lesson. But and you think there's a strong correlation to that, what you're seeing on the chart. And that can be true for sure. That's the whole idea of using momentum. But it's not always true, as far as, an exact lineup there, as we learned there. So that's something just to be aware of when you're looking at momentum. A couple other things too is, momentum sometimes does mirror the price move, because momentum is tracking the closing price X number of days back, certain number of days back. So we're looking at that. It will appear as a smooth line, a smooth price line. And the more days in your look back period, the smoother the line. We had used in another lesson the example of 10 days. If we had gone further back, like 20 days, that will actually smooth out the line. So if you have some real highs or lows, some outliers, that'll continue to smooth that out even further. But unlike the moving average, it does not include all the days in between. By omitting that extra information, the line gets smoother. So what I mean is, we're looking at 10 days back, we're looking at the price on that 10-day back. So if that was an outlier, that would impact your momentum. But it's not looking at the prices that are happening in between like a moving average would. And that's what we were talking about. However, if you have a 1-day price spike, you may see a jump in momentum for a moment, but later you will see a sudden drop as the data is excluded from the series. So you have that 1-day price spike. Let's say it's a price spike up. You're going to see your momentum indicator have maybe more of a change, maybe more of a dramatic change, and then it's going to account for that in the next day as it looks back at its look back period. So the spike situation is where it pays to look at price bars, right? We had a whole section around spikes and obviously looking at your open, high, low, close, or your candlestick price bars, and not just look at momentum, as that could be a little bit misleading. So don't necessarily trade just on the momentum indicator. Again, different than momentum investing, but it's just trading on the momentum indicator. In fact, I think where momentum really does well is using momentum Some use it as a primary indicator, but I think it works best as a secondary indicator. So you're using another indicator, for maybe your price, or you're seeing something form, maybe a doji or something like that. You're using a gap. We looked at a gap. You're using something else, and then maybe you'll use momentum to confirm that. So it's best to use it as another indicator. And if you're using it with another indicator, you can have your other indicator be the primary and then momentum be your secondary. Or you could also use momentum as your primary at that point, but you would use something else to kind of give you confirmation on it. It's really best with momentum to have some type of pairing and not use it just all on its own. Now, there are ways to adjust momentum or filter momentum too. If you shorten the momentum time frame, like we use an example 10 days, but if let's say you shorten that to real short, like 3 days, you'll be more responsive to price changes. It's going to be the more recent prices, right? It's only a 3-day look back as opposed to a 10-day. Again, it's only looking at that specific day. That's what momentum is versus a moving average. But the idea is it'll be more sensitive to those price changes. And if you have a shorter time frame, it's going to show more buy and sell signals. You're going to have more whipsaws, or you're more frequently trading, and you might have some potential losses based on false trend signals, or maybe some more expense there depending on how you're placing your orders, because you're going to have more trading orders, and that if you reduce your time frame as far as momentum to have it be more responsive. Another thing you can do with momentum too is you can filter it with a trading rule, or apply a trading rule. So example, instead of buying or selling when the momentum line simply crosses the zero line, you could say you will take a buy or sell action only when the momentum line is crossed by more than 2%, right? So it's got to be at least 2% above that zero line or 2% below that zero line for a decision to be made. So now if you think about that, well, there's an opportunity cost by delaying for that 2% to be in place, and that's exactly true. That's what happens with filters. It helps strengthen your decisions, but it also costs you in terms of opportunity costs that you could have bought in. Let's say you could have bought in a little bit earlier and had a little bit more profit by getting in earlier than waiting for that 2% to happen. But again, that'll help eliminate whipsaws. It'll help reduce whipsaws, help strengthen your buying decisions, especially if you're coupling it with another indicator saying, all right, I see this other indicator, this primary indicator out there. I'm going to follow my primary. I'm going to use momentum as my secondary to confirm, but I'm only going to use my momentum to confirm if it's, let's say, 2% above the zero line and my primary indicator is still showing a buy signal. Now I feel confident to maybe make a trade, maybe even a bigger trade at that point. So that's another way that you can kind of start putting this together. And later in the course, we talk about how to kind of do this and start pairing up different types of indicators. And momentum is great to pair up with other indicators as well. So with that, that's the building block of momentum, and you can just trade right on momentum, or you probably see it as ROC, or rate of change, and that's very, very effective. But there's a couple other ones that I want you to take a look at here that are in the momentum family that build on that, and so let's look at those in the next couple lessons here, and then you can kind of choose which one you like best. All right, well, you may be actually saying to yourself something like, Steve, momentum or rate of change is nice, but I don't want to wait as long to buy or sell before it crosses the zero line. I want to, kind of get in there a little sooner. If that's true, then the very popular RSI is for you. So RSI, or Relative Strength Index, is a momentum indicator, and it's a much faster than the rate of change or traditional momentum as a signal that an impeding price change might be happening. So it's a good tool. How a lot of people use it, it's a good tool for profit taking, recognizing maybe my security's gone up in price and I've got some profit, and now I'm watching this RSI to see when I might want to sell or take that profit out, because it's going to give me a little faster signal than, let's say, the traditional momentum indicator, or ROC. It can be less reliable, though, for buy and sell signals, so you have to kind of think about that as well. It's good, but it might be a little bit less reliable in terms of deciding the actual time to actually buy or actually sell. But it can give you an indication that something's changing, something's coming. So you can use other indicators maybe to determine your buy and sell signal, like I'm going to buy or sell based on this primary indicator, but then I'll use something like RSI to kind of confirm that and say, yeah, RSI is a little less reliable, but these are real reliable, so I'm going to use that RSI as an additional confirmation and then I'm going to make my trading move. So that's where RSI can be really powerful or strong in that way. As I mentioned, it's part of the momentum family, and so it means it's looking at the relative speed of the price changes, or how is it accelerating, deaccelerating. And the difference is it's going to use averages over several days rather than a single price point. So you remember from the traditional the ROC momentum lesson, or rate of change, it's basically if I was looking at 10 days, I would go back 10 days and look at the price there for momentum in using that, the system, the platforms will automatically calculate. But it's basically a 10-day, in that example, look back. And just that, it doesn't care about what happens in between, it's just that 10-day one. RSI is nice where it's going to use the averages over that period to kind of give you a better kind of look at as far as the signal in terms of price points, and that is what helps it to be more sensitive, let's say, than a typical ROC, and be able to be more faster acting than traditional ROC as well. So for those who love math, you don't have to calculate this. The trading platform will automatically put you in nice little lines and charts, on your chart. So, but if you're wondering, this is the kind of the calculation behind it, as far as there's a step 1 and a step 2 to kind of figure out the RSI, or relative strength index is the combined to do. The one thing you want to take away from it, though, is you can see from the math part of it, is RSI is what's part of is momentum, but it's also part of what's considered the oscillator subcategory, subfamily on it. Basically, what an oscillator does is it converts to positive numbers between 0 and 100%. So if we remember rate of change, we had a 0 line and we could be above 0 or below 0. There's no 0 line. Well, there's a 0 line, but there's nothing below the 0 line. It's going to be all positive numbers. And most of those ranges, and most of those things you're going to see are going to range between 30 and 70%. And when you're actually seeing things on a chart, you're going to see that. Also, the default for RSI, as far as how it was developed, is 14 days, 14 trading days, is the standard for RSI time range. You could use other time ranges. You could use, 14 periods, so it could be 14, hours, 14 minutes, whatever you might want to do. But the standard was built around days, which is 14 days as the standard for an RSI. If you go longer than that, you're going to see more false signals taking you out of maybe a possibly longer trend if you're going longer. And if you go shorter, you might experience more frequent trading, because it's going to give you signals to be buy, sell, more frequently. So 14 days seems to be the sweet spot when you're using an RSI, and I would tend to recommend just staying with that. It'll be a default in your trading platform. You can change it, but that would be kind of the default and what I would recommend using too. So what really RSI is telling us is it's going to really tell us about overbought and oversold conditions. That's a big thing that's going to tell us about. So if you think about an overbought condition, traders are thinking the current price rise trend is at an extreme, right? It's overbought. The prices have gone up to the top. And traders are starting to think, it's starting to settle down now. There might be less people coming in to buy. It seems a little overbought. So we might be ready for a turnaround to happen at any moment where the prices are going to start falling now. So we might want to take our profits now. We might be getting towards the peak. Again, it's hard to predict the actual peak and trough of a price, but the idea is you want to get as close as you can. And so when you have this overbought condition, your RSI line is going to cross above the 70% line. So that's kind of the magic number, the one you kind of keep in your head, and we'll show you in the examples here coming up. But when it crosses above the 70% line, that's showing there's an overbought condition. And if you own the security now, it might be time to sell. You can use as a primary. You can use the RSI as a primary tool to be watching for these overbought conditions, or it's also really good as a confirming indicator too, using it with other indicators. Oversold conditions would be kind of the exact opposite. Traders think the current price has fallen to an extreme. It's gone way too far. And there's few sellers right now, and the price is relatively cheap, and people are not willing to sell anymore. They just think it's gotten way too low. So it might be ready for a turnaround in terms of going back up. So buyers are starting to come back in, and as it starts to go back up, even more buyers will come back in, particularly if a trend forms, you'll start seeing a lot of buyers coming in and really drive that price up. So with the RSI, a security would be oversold when the RSI crosses below the 30% line. So above the 70% line, overbought. Below the 30% line is oversold. Again, you can use that as a primary, or it's also actually very good as a confirming indicator. Also note too, in terms of overbought or oversold, that when trends are strong, the stronger the trend, in securities can be overbought or oversold for longer periods of time. And that makes kind of sense, right? We've already got this long period of this strong trend that's well established. People are going to be a little less reluctant to get off that train, to get off that trend train, because it already looks very good. So by using RSI, we can kind of recognize, hey, the train might be coming to an end here, or might be coming to the station, time to maybe sell my security. So if we own it, let's say in an overbought condition, like, oh, okay, you guys are still excited. We've been having the strong trend for a long time. I've got another indicator saying, a turnaround might be coming, and my RSI is telling me a turnaround's coming. Might be a great time to get out. So that's how you can kind of use it as far as that relative strength index, looking for those overbought and oversold conditions. And that 70% and that 30% line are the key parts to that. Let's take a look at that. So if we look at this sample RSI chart here, and as we know, the relative strength index, if the lines are crossing below 30%, that means it's oversold, and would be a buying opportunity. And if the RSI crosses above 70%, that's indicating that we're looking at an overbought situation and a sell opportunity. And in this example, and the ROC, of course, is related to the zero line. So this is not on here yet, but we'll talk about the comparison with the rate of change in a moment here. But as you can see, in this particular one, it never does get to the 30 line. It never does even, it gets close. It gets around 50%, which is an indecisive area. It could go either way. But if we look at this particular chart, it is telling us that there are periods where it's above 70. You can see in the far right where it's in the upper left too, it says 83.11. That's the actual measure. So not only is it above 70, it's actually quite above 70. And in this particular chart, it colors it in, which is nice to be able to visualize that easily as well too. So those would be, traditionally it would be like a sell type opportunity when you see that. If we use the same security and now we put below the RSI, we put the ROC, you can see how they follow along very similarly. As far as the movement of the lines are very similar in pattern. The ROC, of course, is going to use that zero line. And if it crosses above the zero line on the ROC, as we recall, that's a buy signal. If it crosses below the ROC, that is a down or an uptrend signal. And if it crosses below the zero line, that's a downtrend signal or a sell type signal. Now, if we look at these together, one thing that you'll see here is you notice how in the ROC, how it goes above and below the zero line pretty frequently there in the middle. That's that whipsaw effect where it's whipping above and below the line, causing a lot of frequent buy and sell signals. And the RSI above does not have that. Remember, the RSI is at 70 and 30. If you look at that same part of the chart, there's no buy and sell signals. It's really truly showing that there's a period of indecisiveness. So you wouldn't be as actively trading. You wouldn't be potentially taking on more fees or more potential for short-term losses around this because it's filtering all that out with the RSI. And that's why a lot of people really prefer the RSI from that aspect, as it does tend to take out those whipsaw actions, as you can see in this example here. So RSI's relative strength index is extremely popular. Many times it is a default, when you go into a trading platform, and they might automatically put things like candlesticks in your chart, or they might automatically put other types of indicators in your chart, or above or below the chart. RSI is a very popular one that sometimes is a default. So that means it's very popular, very useful. A lot of traders are looking at it, and a lot of people use it as sometimes as a primary, but a lot of times I like to use it as a confirming something else. So RSI is great. So take a look at RSI as being part of that whole momentum indicator family. Another great indicator that you can use to really identify overbought and oversold positions is the stochastic oscillator, which just has kind of a fun name too, doesn't it? And since it's an oscillator, we know that the numbers are going to be positive numbers from 0 to 100%. Again, not going to show the price, it's going to show a percentage from 0 to 100% that you can use to evaluate. And we're going to show you that in a moment here. Oh, by the way, too, it's actually kind of poorly named. Stochastic actually means randomness. And what we're trying to do is find out order and patterns, right? And then it does help us with that. So I don't know why they chose that name, but it's not the perfect name for it. But it's a good momentum indicator. So let's take a look at the stochastic oscillator. So what it does is it looks not only at the closing price, but also how near is that close to the high or low of the day. You saw on some of our other types of momentum indicators, we're really looking at closing prices in a look-back period. and whether that's a certain day or an average. Where this is going to get a little bit more mathematical and also look more how does it reflect both the high and the low of the day as opposed to just closing. So for example, if you have a close, the closing price is near the high, and each high is higher than the day before. Not only do you have an uptrend, but you have an uptrend that is accelerating. It's getting faster, it's getting stronger. So in a rally, prices will keep going up like that. Prices will keep going up, and you expect the price to close near the high of the day. In a sell-off, the opposite, prices are going down. You expect the price to close near the new low of the day. So in the example and in this little description, you can kind of see we're trying to measure, how strong are these trends? Are they accelerating? And stochastic oscillator, using that mathematical equations behind it, does that for us. In fact, if you're curious about the math behind it, here you go. Again, the trading platform will automatically do this for you and automatically put the lines on the chart there for you, so you don't have to worry about doing the calculation. But it is an interesting calculation. There's some parts you need to kind of know about on there. One is you're going to see, because you're going to have some inputs later here, and we're going to talk about that, or some choices here in the next slide. First off, when you see something that says percentage K, that is the stochastic oscillator. So that if you're looking at percentage K, that's the indicator. And then it's going to be compared to a 3-day simple moving average, how the formula was developed there back in the 50s. And that's going to be identified as percentage D. Don't worry, there's nothing else in technical analysis that has a percentage K and percentage D or gets weird like this. But on your chart, you're going to have these two lines, and they're going to be labeled percentage K and percentage D. Again, the percentage K is the stochastic indicator, and percentage D is a comparison to the 3-day simple moving average, and you're going to look at these two lines in tandem. Now, let's get to the worst slide of the course. Well, maybe not the worst slide, but they make it a little bit more complicated for you, if you want it to be. So there's 3 common types of stochastic oscillators you can choose from. And usually these are all on your trading platform, and they're labeled a little bit weird, so I want to make sure I covered that for you. So you're going to see them labeled as fast, slow, and full. I wish they had better names, but that's what they call them: fast, slow, and full. So the fast stochastic oscillator, that's the original one. That's the original one we just looked at as far as the mathematical calculation. That's the basis. That's the basis for everything. So that's the base. Then you can choose something like a slow stochastic oscillator, which will help make your percentage K look a little less choppy. It smooths out even more. And you can see how the formula changed a little bit more. They added smoothed it out with a 3-day period SMA built right into the percentage K, and then comparing that to the 3-period SMA of the slow K, or slow. It's this 3-day SMA basically is what it is. It's the slow percentage D. So what you're really getting with the slow one is a little bit less choppy of lines. You see them a little bit more choppy. You want to smooth them out, a little bit more. Then you could use a slow stochastic oscillator. And then there's the full stochastic oscillator, and all that really does is allows you to customize the number of periods. As remember, the number of periods is a kind of a default there. And that default is 14 days. If we were to look at the formula back in the previous slide, it's a 14-day default. So, but if you wanted to change that from 14 days, you can put in whatever number of periods that you want. And that's really what the full stochastic oscillator does. This gives you more flexibility in days. Again, a lot of research on things around stochastic oscillators. 14 days chosen for a reason. So it matches up with RSI, similar type thing. So you might want to stick with that. I would certainly recommend it. But you can also, it's perfectly fine if you become more comfortable with your trading. If you want to have more customization, you can certainly do that. I will tell you that most people use the original formula in the original format, or so they're choosing in effect, the fast stochastic oscillator if they have a choice on their trading platform. If you don't see choices, usually they give you one. But if you don't, then just if it says stochastic oscillator, understand that is the original formula and that is the fast one. Again, wish better names. So if we look at it graphically here, you're going to have your percentage K, the stochastic oscillator, and then your percentage D, which is that 3-day simple moving average of that percentage K. So it's a relationship between the two. And what it's going to do is it's going to generate 2 lines on your chart. You're going to see, you can kind of see here where it says STO, stochastic oscillator. The percentage K is 14 days. That's the default. The percentage D is 3, because that's the 3-day simple moving average. So that's the default too. Generates 2 lines on that, and you can see the 2 lines here right on the chart. and you can see that they kind of move a little bit in tandem, and you can see how the 3-day one, the pink one, is a little bit more smoother versus being less up and down. So that's because it's a shorter look back period. If you were to customize these and put, let's say, an 8-day as the for your percentage K, if you did customize it, it would then smooth out that percentage K a little bit more. But we like to use the default here, so that's what it kind of looks like as far as the default. All right, so that's great. Now, how do we use it? Well, here's how you use it, because you're trying to, again, recognize these overbought and oversold conditions. Overbought, traders think the current price rise is an extreme. It's too high. We're ready for a turnaround, and so we want to take our profits now. We're reaching the peak. So an overbought is indicated when the stochastic oscillator crosses above the 80% line. So in this case, you're looking for the 80% line, and you're looking for it when it's overbought, and you want to look for that. You're looking for it to be above the 80% line, and you're going to actually make the sell decision that it's overbought when the percentage K crosses below the percentage D. Okay, so you got two things going on here. We're looking for that overbought condition, and then we're looking for a sell signal, and that's going to tell us when we think we're getting really close to the peak, and that's that percentage K is going to cross below the percentage D. The overall or an oversold condition is when traders think the current price fall is an extreme. It's gone way down in price. There's few sellers, and the price is relatively cheap, and it's ready for a turnaround. That we're thinking buyers are going to start coming back in. And how we see this with a stochastic oscillator indicator is an oversold is going to be indicated when the stochastic oscillator, the percentage K, is below the 20% line. So there's no below zero. Remember, it's an oscillator, so it's between 0 and 100%. And there's no prices. It's a percentage, so it's going to go below the 20% line. And we're looking for the percentage K to cross above the percentage D to give us the indication that's the time to buy, right? So it's kind of like these two kind of sets of conditions that you need to meet for it to be kind of implemented. So if we looked at this again graphically on here, you're selling when the percentage K is above the 80% line, showing an overbought condition, and it's crossing below the percentage D. Now let's look at that visually on the chart there. And the same thing, you're going to buy at the low part when it's below the 20% line and crosses above the percentage D. So you can see where we have highlighted real strongly the blue lines there for the 80 and the 20% on the right hand side. And you can see in this example with Tesla, there's conditions where it does that, where it's above or below, and it crosses over each other to kind of confirm the pattern within itself. And there's times when it's in between, and then you're taking no action at all. It's just neither overbought nor oversold. It's just kind of waiting for something to happen. Well, either a sell signal or a buy signal for that to happen within there. And in this view, you have the price chart on the left, and on the bottom of the left, and on the top is the stochastic oscillator. And you can see where the lines are crossing the 80 and 20% line, and also when they're crossing each other. And you can kind of see where that's happening, where it's looking at the chart itself on the right-hand side there, when that starts to kind of match up. And again, you want to have those two conditions be met, and that's the whole idea, is you're trying to anticipate these buying and selling conditions. So if we look at the chart on the right, you can see where once we cross, actually when the crossing happens, that's when we see we're on this uptrend firstly, and we see the cross, it's above the 8% line, it crosses below, and that's where we're going to sell. And then as indicated, the indicator worked, and it showed a downtrend from there. Then it flattened out, and then we saw we're kind of bottomed out. And as we saw it start to rise above that 20% line, we saw a buying condition, at least for a short period of time, where it might have been in a buying area. So that's another way that you can kind of look at these two as far as with the price charts. But a great way is to start just with your stochastic oscillator, be watching that, and then confirm it with other types of price indicators. By the way, we talked about fast, slow, and full stochastic oscillating charts. Fast is the original, with a 14-day. The slow is one that uses the original and kind of smooths out that 14-day price. And a full one is the one where you can input your own numbers. So if you look at the first two ones here, it's the exact same chart for Tesla during the exact same time period. And you can see that the one below, the fast STO, or stochastic oscillator, a lot more jerky up and down, a lot more up and down there, not as smoothed out as far as the black line. If we make that into the slow one, you can see how it now adds an extra smoothing factor with a with a factor built into the equation, the SMA built into the equation, the simple moving average, in addition to the percentage D. And so that makes it a little bit easier to read and see as far as when these lines might be crossing. So sometimes you might see something using your traditional one, your original one, and then it's just a simple click of a button or two to overlay it with a slow one or replace it with a slow one to kind of see it a little bit better visually. Again, the full one on the bottom that's all customized between them. So whatever you put in is going to have a dramatic input on the chart. I used the 10-day for a shorter look back to see if it was more price sensitive, which would be more price sensitive by using it in a full STO. So if I like it, but I want to be more price sensitive and even more reactionary, then I might put in a shorter time period versus, let's say, a longer time period. So as you play around with this, you can kind of get an idea how they look. I would say most people, they're using the traditional, the original STO, or will be termed as a fast, and then they might use the slow one to just kind of see it a little bit visually right before maybe they're decide they're going to do something, and they want to just make sure they're seeing what they're seeing a little bit clear, and so they'll use the slow one in that aspect. So we learned some powerful momentum indicators, some oscillating indicators that can be really, really good. And you might be asking yourself, okay, what's the difference between an RSI and the stochastic oscillator? What's the difference, and is there a better time when I should use one or the other? And that's what we're going to talk about in this lesson. So first off, let's talk about their similarities, because it's more similar than different, actually. So with the stochastic oscillator and the relative strength index, they are both widely used. So they're both widely used. They're both very, very popular. They're both momentum oscillators, so that means it's going to be between 0 and 100%. So they're all going to be percentages, and they're all going to be positive numbers. They're really looking at these overbought and oversold situations. That's what we're trying to identify as we get closer to peaks and troughs of overbought and oversold securities. And they're simple to use. They'll simply, you can just choose your parameters, or just choose it, and it'll overlay the graph, and you can just watch for the, as we learned in the previous lessons, you can watch for the conditions, the buy and sell signals. And they're really good to use to confirm with other indicators. So if you're using something else as your primary indicator, a candlestick pattern, a chart pattern, maybe a moving average, whatever it might be, these oscillators, these stochastic oscillator and relative strength index, are good to use to kind of confirm what you're seeing. So really what the big difference is, and how we might apply that, is under the underlying philosophy, which gets into the math, which gets into the calculation. Again, you don't have to calculate on your platform, but if you think about it philosophically, this is where the difference comes in. The stochastic oscillator is predicated on the assumption that closing prices should close near the same direction as the current trend. So if you've got an uptrend, you should have uptrending closing prices, and that close should kind of close near that same direction or in that trend. So it emphasizes that trend part of the closing prices. The RSI is designed to measure the speed, the acceleration or the deceleration of price movements. They both kind of do that a little bit, but RSI, that's really all about speed. That's really where it shines and where its strength lies as far as in that. So key is which to use when. Is there a strength of one over the other? Well, they're both actually very good in what they do. That's why they're so similar. So it's more the similarities. But if we were to nitpick and say, well, if we were to really say, okay, what's the best for each of these versus they're both good in any of these types of markets as an oscillator, as a momentum indicator, a stochastic oscillator tends to be best for choppy or sideways markets. Where there's no great trend identification. There's nothing great where you've seen a trend be identified, because it's trying to help identify, or it's kind of helping you decide whether it's overbought or oversold, and there's not a clear trend. And so if it's used in a strong trend thing, sometimes that can cause a premature exit. Let's say if you're in a strong upward trend, and it's accelerating, the stochastic might not show that as much, and you might exit a little bit sooner with a stochastic oscillator. As opposed to, let's say, the relative strength index, which is really great for trending markets. Is it accelerating that trend? Is it getting strong? Or is it decelerating that trend? And that trend could be either up, an upward trend, or a downward trend. But it's really great for those markets. Now, as we saw in the lesson RSI, it can also help reduce the choppiness and things of whipsaws that a standard momentum, the basic ROC, or rate of change momentum indicator uses. But if we were, and that's why stochastic oscillators and relative strength index are both, I would say, better than the momentum indicator overall, depending on how you use it. But that's just an opinion at that point. But the RSI was good for identifying and taking you out of that less trading range too. So this is, again, all real kind of nitpicky stuff, real kind of detail stuff around it. But I would say certainly if you've got a market that's really trending strongly or trending and you're working a trend, I would definitely tend to rely on that RSI. Stochastic oscillator can give you those false signals in those trending areas. So really the big takeaway from this is if it's a strong trend, either way, use the RSI. In this section, we're going to talk about volatility and how to measure it. Now, at first blush, you might be thinking, oh, volatility, that's bad, right? Bad, not good. And actually for traders, the volatility can be actually very good. Really helps separate you from the crowd as far as using indicators and different things. And for some traders, they seek out volatility. They seek out securities that are very volatile and things like technology stocks or cryptocurrency or whatever. So if you like volatility, or you'll like this lessons, and if you don't like volatility, you're going to actually understand a lot better and understand how you can use it to your advantage and make it a little more comfortable with it. So what is volatility first off? Well, it's simply a measure of price variation. Highs and lows, prices are going up and down all day long. And all volatility does is measure how much that's happening and how fast that might be happening. So the high and low over a period of time, or the variation from a fixed measure, gives you a feel for volatility. So this is my fixed measure, and I have a security that just trades a little bit above and a little below that fixed measure, less volatile, lower volatility. Higher volatility would mean that I have this fixed measure, and we're going to learn about these indicators that we'll use in the fixed measures that they use, would have much bigger swings, so much bigger swings in price, both up and down. And higher volatility, basically what that means that there's really higher risk, but also higher reward too. Higher risk that maybe you didn't make the right choice or it didn't turn out the way you thought it would, and you have a losing trade. But higher reward too, where there's might be more potential within those trades as far as more price variation, bigger opportunities for profit in more volatile stocks. And so that's why in securities, that's why some traders really like more volatile securities. They want that potential for more reward. There's more possible outcomes in a more volatile security than one that's less volatile. So there's no right or wrong as far as volatility. It just kind of is, and how you approach it might be the difference, and how you apply the indicators is what'll be a difference between different traders. And so a change in volatility really is implying a change in the expected price range to come. What's that price range going to look like coming forward? Very important for us to know. So that's a good thing that we want to find that out, and volatility indicators help us with it. So a non-volatile security delivers a narrower range of possible outcomes than one that's a more volatile security. Right? That makes sense, right? And thus, again, a typical technology stock or Bitcoin or cryptocurrency is generally more volatile than something that's, like a utility stock that has very little variations in price. So the main reason to look at volatility is to reflect the changing probability of a gain or loss. What is the possible outcomes that if I make a trade, that I'm going to have a gain, and what is the chances I may have a loss? And can I look at volatility in a way to kind of make this work in my favor. And the good news is you can, and that's what we're going to learn about up in these upcoming lessons. So let's think about for 1 second here, though, how does it arise? Where does volatility come from? And you can really think of volatility as crowd sentiment, right? So, what does the crowd think? What does the other traders think? So volatility rises when traders get excited about a new move. Maybe it's a new event that caused a new move. There's something in the news that is causing something to happen. And the price starts going up to new highs, or possibly, depending if it's bad news, might be going to new lows. Either way, traders are taking notice. They might be excited, maybe disappointed, but either way, the crowd is getting involved and they're noticing, and so it's causing this volatility, this price range, this wider price range. So the start of a new move is when you see higher price highs and lower lows, right? So you've got volatility. When a trend starts to establish, you're going to look at for higher highs and lower lows, whether it's an uptrend or a downtrend. And so volatility can really kind of give us an indication on when that move might be happening. So volatility, and this is the key part, volatility tends to be abnormally low just before a turning point, and abnormally high at the first big thrust of a new trend. You know, it's always, nothing is 100% perfect. There's always noise and, you know, false signals and things in the market. But if you think about it, if we're looking at volatility measures and the volume is low, or excuse me, the volatility is low, just it might be indicating that there's a turning point coming. So we're looking at a turning point. And if it's abnormally high, that means, okay, people got excited. Now the new trend is not, it's not a turning point now. Now the trend is getting more firmly established. The first big thrust of a new trend happening. And that's where volatility can, you know, we can see these volatility measures indicating that. So if you think about it, where it's helping, volatility is helping us to identify turning points and establishing strong trends. Two really important things I think we'd want to know, right? So the volatility measures can be very, very helpful in a lot of ways. Also, when you think of volatility, think about your trading style. And then you don't have to decide that now. Your trading style will develop as you start doing trades. You do paper trading in practice. You'll kind of develop into that. But if you have a feel for what your trading style might be, that may be how you might use volatility measures too. So trading style matters with volatility in terms of how you look at it. How do you look at risk and reward? Are you willing to take on more risk for more reward? Thus, you'd want more volatility, for example. Also, the time frame. You know, longer time frames will tend to smooth out volatility, right? You have more time to kind of base these measures on versus, let's say, a very short time frame. And then the focus of your investments, as we mentioned, you know, certain things like technology, cryptocurrency stocks attract people who are comfortable with and like volatility. So it doesn't mean you can't trade in those areas, not at all, but just understand you're going to be in a more volatile area than, let's say, in other areas. And there's trading mechanics we can actually use to help us with volatility too. So, you know, we can put in like a market order, not a market order, but an order, like what is called a stop loss order or stop loss level setting, so we can kind of reduce our losses. So if you're like, I want that reward, but I'd like to reduce my risk a little bit, you can actually use some trading mechanics that we'll learn about later in the course on how to do that to, you know, put in the correct order to help reduce that downside risk and still give you a good chance at upside reward. So that gets into the trading, you know, mechanics part coming up later in the course. All right, so let's learn even more about volatility and start talking about what types or degrees of volatility we might be experiencing out here, and some indicators that we can use that are specific to volatility, which is really looking at market sentiment and looking for those turnaround opportunities and those opportunities that, oh, a trend is established and we see that first thrust because we see an increase in volatility. And turn volatility to a good thing. Okay, welcome to the Matrix, the volatility matrix. If you saw the movie The Matrix, that's a great movie, the first one. The sequels can be debated. That's up to you. If you haven't seen the movies, you should. Certainly the first one was terrific. But with volatility, you can kind of think of it like a kind of a matrix where there's matching up between the type or degrees of volatility. And volatility, as we learned, can be abnormally low or abnormally high. Low, you know, just would typically be just before a turning point is coming, and high would be the first big thrust of a new trend. But you also need to consider, when you're looking at that volatility, is something trending or not trending already before this, you know, low or high volatility, you know, starts coming into play. So we're going to look at that kind of matrix between these four kind of concepts as far as putting that all together. And we're going to look at that graphically, and then we're going to break this down in great detail, looking at degrees of volatility. You may hear the term variance, that's okay too, but, you know, so variance or volatility can be used interchangeably. And we have these long, you know, straight lines basically representing the high and the low. So we're looking at the range of prices. So that's what volatility measures look at, is you're looking at ranges of pricing. And as you can see, we have these different types of combinations of variance or volatility and with or without trending. So let's look at each of these in turn now. So when you see low variance with trending, right? So there's very low volatility, but it is trending. It's part of something that's already there. So you would see it, something being low variance would be very orderly, right? There's not a lot of ups and downs and a lot of movement all over. It's all very orderly. And you can easily see the trend too. So low variance with trending. And this is a great opportunity. This is, you would consider the best trade opportunity with the highest probability for profit and lowest probability of loss in that. And you know, your reason for this, you're better able to project the future price movement with more confidence than with a high volatility security, because it's all nice and orderly, very low volatility. and generally, hold a low volatility with trending for longer periods of time, which can help reduce like trading fees or other types of fees too. You can kind of let it ride a little bit because you're not getting a lot of ups and downs. It's all very orderly. It's trending in a certain direction. That trend could be either up or down, by the way. This happens to be low variance with trending, and as you can see, we're definitely in an upward trend. So if we bought earlier, we could feel confident that that trend is going to continue, and that's all very orderly. Here's an example now. If we look at another way, we're looking at low variance without trending. Again, low variance, it's going to be very orderly again. You're not seeing real high highs or low lows or anything like that, and all mixed up. It's all very orderly because that's the low volatility or low variance part, but it's moving sideways. There's no real definite trend, either up or down. So you really don't know which way it's going to go. It's not real predictable at this point, and you really shouldn't trade it because you don't know what's going. You can't really try to use an indicator and really try to base a good logical decision around it. So there's no basis for an expectation of gain. You're almost a little bit more guessing at that point. So it doesn't mean you can't trade. I'm just saying look for better alternatives, right? There's always better alternatives than trading into something that might be moving more sideways. That's highly hard to predict. But you can see very orderly, moving sideways is low variance without trending. Now, one thing you can see when you see this sideways movement, you're trying to see if something is going to change. You can use your other indicators to kind of recognize when you may have a reversal or maybe a breakaway gap or something that's going to establish a new trend. But there's an exception when you're looking even at, let's say, volatility, is there's still no trend emerging, but if the bars, the whole trading range from high to low, start to contract or widen, that's a powerful signal that a breakout or a new trend may be coming. Although you don't know which direction it's happening yet, unless you're using other tools like candlesticks and your other indicators. But if you have that orderly low volatility, low variance without trending, and then all of a sudden you start to see the highs and lows start to contract, as you see in the example in the circle here, that means that something might be happening where now we're going to see a dramatic move in another direction, either up or down. So watch for that contracting, or it could be an expansion of the bars too. Either way, there's no, it's starting to get a little less orderly as far as the bar length. So if we look at high volatility or high variance with trending, so there's a trend, but there's a lot of variance within that trend, and it's really not orderly at all. Remember our low variance with trending, how nice and smooth that all looked, and nice, just generally marching up the mountain, so to speak. Well, here it's a definite going upwards in that example, but it's all over the place as far as the pricing. So there's a trend, but it's not clear or possibly as strong because it's so volatile. Now you can trade it. It is a trend, right? We want to trade on trends, but increased volatility can increases the potential for loss. So because it could be going up, it could reverse. There's just a lot of volatility with that. But when you know that you're in a high variance with trending, you can trade that and then understand and then adjust your settings on how you might place an order as far as what you're buying and how you're buying it. And you can execute something that's called like a stop loss order sooner. Basically, a stop loss is setting a lower, where you buy something and then you set a price level below it to, if it falls below that price, your platform is going to automatically sell it for you so you don't, experience as deep a loss. We're going to go all into that, by the way, in the order section, and we're going to talk a lot about stop loss because it's very important when you're trading securities. But for now, just to understand that there's ways to get through, something that's trending in a great manner, but there might be a high volatility. Again, the trend could be either upwards or downwards. You're looking at it and you're saying, but there's very volatile. There's not much order to it at all. And if you see like an established trading range with established support and resistance levels, looking at the chart pattern type section, where you can kind of buy and sell as you approach each of those levels. It's still trending, but it's with more volatility as it moves in the direction of the trend, but it's kind of bouncing up and down against these support and resistance levels. So you can kind of watch that, but that's more of a trading on a chart pattern as opposed to trading on a volatility with trending pattern. But you can do it. And then lastly, if we look at high volatility or high variance without a trend, there's no established trend, and there's a lot of volatility, really a lot of price ranges, wide ranges and price movements all over the place. So it's not orderly at all, which makes it harder, but also there's no trend. So it's really hard to predict the next price move, particularly since there's no order to it, and there's really volatile up and down all over the place, so it's hard to predict what will happen next, hard to use your indicator. So what you should do is really don't trade it. Look for better opportunities. Look for something that has some more of a trend to it. Whether it's with low volatility or high volatility, at least you've got a trend and you can use your indicators and make better trades. So don't trade high volatility, high variance without trending. Look for something better, something that's trending. Alternatively, when you see this, one thing you could do is narrow the time frame down to like a smaller time frame, like an intraday time frame. Say 15 or 60-minute bars. And look for tradable swings to get in and out. So if these bars that we're seeing here in the example represent a full day of open and closed trading with as far as our range of highs and lows, inside there it might be some trends inside those days, and you're trading on a 15 or 60-minute bar or even less than trading on something on a day type thing. So that's what day traders would do, or swing traders. Some folks that are looking at these shorter time periods, they could still trade a security they're interested in. They just might need to get in and out faster when you're seeing high variance without trending, and you're really looking at that point not in overall day trends like this is representing here. Each one is a high and low of a day. You're looking inside each of those single day bars, trading within it, and then getting out and closing your positions. So that's our matrix of the degrees of volatility or variance with and without trending, and you can kind of get a feel for whether a reversal might be coming, or if there's a strong trend or trend continuation, or maybe we're just going sideways here. And then we have some indicators that we're going to now learn about that really help us to understand a little bit more about what's going on with volatility, and some real good ones to help us as far as actually making trading decisions on whether we want that to be a primary indicator, or maybe we're going to use some of these volatility indicators as a second or third indicator to help confirm another trading indicator that we might be using from another lesson that we've learned that can be real helpful when you're looking at volatile types of markets. And then it's a matter of the degree of that volatility or variance. Okay, let's look at an indicator that you can use to start measuring this volatility and start seeing how we can use it to our advantage. And one of the real popular ones, kind of one of the long-time classic ones, is the ATR, or average true range indicator. And it's really a way of looking at volatility, is looking at the averages of the highs and lows. So do this way, highs and lows over a period of time, which, as we know, is our trading range. Our high and our low is the range of our prices that are going in a trading range. And what we're looking for is range expansion, where the range gets bigger, or range contraction. So what's happening here when those things happen? So range expansion, as you know, if we start here and all of a sudden it starts getting larger or wider, it's expanding, the range expansion from our low price to our high price, the highs and lows are getting further apart. And that's an indicator that volatility is rising. It's not trading in a narrow price range. It's now got a wide price range from low to high. So that volatility and that movement up and down between can be rising. Volatility is rising. Again, providing us higher reward with potential more risk, with a lot more trading options in between those highs and lows over a period of time. By the opposite of that, a range contraction would be your highs and lows are getting closer together, right? So volatility is reducing. There's less trading options or choices within a narrower range of prices. So again, that's where we can use this ATR to see a measure like, well, what is happening here? How volatile is the market, by looking at an average true range indicator that you can then, you can choose as an overlay on your trading platform. We automatically calculate it for you. So if we look at an example here, here's an example with Tesla, and you can see we have a line moving left to right. That's time, old time to newest time. And you'll see it's got a measure here. And this is looking over 14 days. That's a standard as far as 14 days. You can change that though, but let's say you're looking at a standard 14 days. And it'll give it a number, like this is 36.83 for Tesla at this period of time. It was 36.83. To give you a comparison, and this is a very volatile stock, right? We know Tesla is a very highly traded, highly volatile stock, wide ranges of highs and lows. If we compare that to, let's say, an Xcel Energy, which is a utility company, pretty narrow range of trading, that's ATR is actually more common, as an ATR is lower at a 1.40. So if you're wondering if you're looking at a particular security and you're saying, oh, is this a real volatile security? Well, the chart will show you a little bit because you see these peaks and valleys, but you can also look at the numbers, the raw numbers, and say, oh gosh, regular old utilities like around 1.4, this is at a 36.8. Now you could compare that to, let's say, other stocks, like a technology stock like Apple or whomever, or Facebook, whomever you want to look at, in some are more volatile than others. Some are more volatile than Tesla, for example. So if we look at the top part here, that's our average true range indicator. And basically you can see the peaks and valleys as you go up and down, and how that kind of matches up towards the prices on the bottom. You can see we've got our candlesticks and we've got volume running along the bottom as far as our trading volume. So what is this telling us? Now let's look at this a little closer, and what is this actually telling us? So you can see over in the far, let's start on the far left, you can see that there's lower volatility, at least relatively low volatility in comparison to this stock. And you can see what's happening with the prices down below. They're not going up or down very much, right? There's not much, trading, there's volume's okay, but not super high, but there's not a lot going on there. It's a little steady, maybe a little bit downward, right? But then as our line starts to change, our average true range, our ATR starts to change and kind of start going up on the upswing, you can see that with the blue box there on the bottom, the range expansion, we're also seeing a definite price trend coming too here as well. Again, we're looking for when things might turn or how strong a trend is. So once it starts picking up our ATR, it's telling us there might be a turn happening. You can see the range is expanding up on the top there, but also our trend is now going up in the upper right there, or our trend is now headed upward too as well. And our volume picked up too, which is another really confirming indicator that something is going on here. And as we hit the top of that, that's where our risk and reward kind of comes from. You can kind of see it's still kind of moving up. The ATR is still very volatile, and then the ATR keeps going up because the stock price actually went down, as you can see on this one. And our ATR is still showing a rising thing because it's still a lot of volatility both up and down, right? So you have to kind of be aware of that a little bit too, as far as maybe not using this as a prime indicator, looking at your other indicators too and the strength of those trends. And then it kind of peaks out there at the top, looks almost like a volcano, and we have this range where it's contracting, it's narrowing, it's getting less volatile over a period of time here. See how it's a little bit lagging indicator. It doesn't do it immediately, you can see, but over time how that line starts to come down on the top to match up with that kind of narrow range in the yellow or orange type box where it's less volatility. And then again, it picks up with the range expanding again, and you start seeing more volatility going up there. In fact, you see a spike in volume there, kind of corresponding to a little bit of a spike in our ATR at the top, and it's all part of an expanding range there too. So you can kind of see how volatility can give you some insight into this as far as what might be happening. Again, I prefer, or I would recommend that you're using this as more of a confirming indicator versus a primary indicator that you'd use, and you might use it with something else. To show, like, let's say I'm in the middle of that contracting, that narrow trading range there, and I want to confirm that I'm kind of in this narrow trading range, that there's less volatility. Well, I can look at that ATR and see it where it's coming off a peak, and I can see, yeah, things are getting less volatile. Might not have reached a turning point yet, and certainly not at a peak or anything of that nature. But I think there's better ones that we're going to talk about here, and one is the Bollinger Band. I think is actually more visually instructive and appealing, helpful. But ATR is very popular, so it's good to know about ATR and that average true range, and that can be very helpful as well. So I don't want to knock it. I just want to say I like this other one a little bit better to look at volatility. So let's talk about that.